can't have lasting prosperity if you don't get price stability first.
People are looking for opportunities to come back into equities.
The outlook is for equities to be rallying into year-end.
Corporations are doing better, navigating very tough environments.
We've kind of maybe been swept up in this optimism, but no matter what, that's got to slow over the course of the next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Mic test 1 2 1 2. It still works, TK.
That's good.
This is good.
Do this?
Just practice, Bramo. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market's slightly negative on the session. This equity market is up big time on the week. The S&P 500 TK up close to 5% so far over the previous 4 days.
It's the way it's up big, John. While you were gone and just before the Fed meeting, like at 1:58, the blinking on the Bloomberg terminal, the red and green, I have never seen a market get out front with a fervor before that announcement and before that press conference.
How many times am I going to hear you say before you were gone?
I think before 6:05,
We can get 5 more of those in?
Yeah.
5 more in?
We'll squeeze them in.
You take time off sick, and every time you tune in, I hear you say it's a good and beautiful thing, and TK look down the camera and say, John's on assignment. John's on assignment.
John's on vacation. I am so glad to have you back.
Thank you. The voice is in recovery mode, so bear with me at home. We'll try and get through this together. Apple on deck with earnings after the close just yesterday. Apple in the pre-market, TK. A little bit softer here for the stock. I know where you're going with your commentary this morning, so I'll offer up the opposing view.
Please.
4 quarters of no growth, okay?
Right.
Problems with the iPhone, struggles in China. You're going to go to margins, you're going to talk about record service revenue, and I'm sure you're going to adjust things based on foreign exchange as well. Am I right?
We are completely addicted to analyzing companies, and our first guest here is actually expert on this today and folding in the way we use 4 accounting statements with economics. And the answer is we are addicted to revenue and somewhere down the income statement dynamics. Cupertino is running this thing for profit. They had a record third quarter gross margin with massive cash generation.
A lot of positives. One of the biggest negatives, though, is 1/5 of their sales in China. We didn't even mention the China factor.
Valid point.
The fact that it came in so much lower than expectations, the political headwinds, the uncertainty of whether this is a lack of demand just from cautious consumers in China, or whether this is actual true competition from Huawei in a new way. This, to me, is one of the biggest existential risks for the company.
It's not an existential risk. It's what we call competition. And we'll see. They've had the competition before.
That's existential.
I get the government angle in all that, but I would notice that, in many of the paragraphs I read, we're parsing 89.x billion versus 89.y billion. They're not doing that in Cupertino. What they're doing is they're looking at the operating leverage of the system. And as I said yesterday, John, from the pandemic, they're up 47% in sales, and they're up 71% in free cash flow.
Wasn't this the objective for the last decade or so for this company?
Yes.
They knew what was happening with the iPhone business, and that ultimately they'd transition to more services revenue.
Up 16%.
And that maybe margins could improve from their TK, and isn't that what we're seeing?
The margins is what the adults look at. They're looking down the income statement at a comparison of, say, EBITDA to revenue, and the answers are steering it in the right direction is a cash machine.
To be fair, though, for the Bears, I do understand the confusion. Bramo, if we'd sat here maybe 12 months ago and I said next 4 quarters, forget it, no growth, and in between you're going to have a stunning sell-off in the Treasury market and yields are going to fly, and then you'd have to listen in the same breath to someone saying, yeah, but I think the stock's going to be 30% higher from here.
But that's the issue, right? It's how far we've gone and how far this is baking in future earnings and revenues, and now there's a big question mark. How much can China be the driver of that at a time where their net revenue keeps decreasing?
It's
and it's unclear the competition.
I mean, Cook is slacking off. I mean, they've only made 25% per year for the last decade.
I knew where you'd began with this. Haven't you already bought the new phone?
No, I don't have a new phone. I still owe money. I still owe money on the old phone.
I think we know where this is going.
I called them up and I said, I'm Tom Keene. Don't I get a new phone? And they said, hell no.
Does that work when you call up and say, I'm Tom Keene? Thanks for being with us. Let's get to the price action. Your S&P 500, slightly softer. It is payrolls Friday and we haven't talked about it yet. Your estimate, 180,000. The previous number, a blowout, 336. Yields this week down hard. On a 10-year right now, 466.16. In the equity market, Tom, equity's up and up big time.
Yeah, it's the way they're up. It's just a massive bid on there, a massive short cover. I think we can all agree to that. But the huge question is now what with the VIX at 15.71. As I showed yesterday, I think we've got it again. These banners on radio are just absolutely phenomenal. The VIX from a 13 level out, OMG, 21. You would have thought we were at a VIX of 30 at 21.71. Fear, blood in the streets, Bramo fired up, and we're back to 15.80.
To be clear, these banners don't work on TV either, just for the record.
No, but they're there, you know.
2 Mondays ago, on a 10-year yield, 5.0187%. Lisa this morning, 466.16.
Which brings me very much to what I'm watching for U.S. payrolls, which do come out, non-farm payrolls, at 8:30 a.m. Everyone's looking for the number to be about half of what it was last month. 157,000 is where Bloomberg Economics puts it. The whisper number is around 200,000. I'm watching the response in the 10-year yield. To me, that's more important, arguably, than what we see with respect to the actual number. Do we see a new balance of risks with respect to a sell-off continuing after the reprieve that we got over the past couple of weeks? Today, Secretary of State Antony Blinken does head to Israel. He does have a press conference at 8 a.m. Arguably, what's more important to me, what I'm watching, is that the head of Hezbollah is going to be speaking in Lebanon around 9 a.m. Eastern for the first time since October 7th, and people are looking to see whether he indicates that they are going to enter the war. And today, Fed Speak is back. Tom, you'll be happy to know. We have Fed Vice Chair for Supervision, Michael Barr, who I know you're actually very curious to hear about, considering
Michael Barr is the one I want to hear from.
Well, you'll hear from him twice. Minneapolis Fed President Neil Kashkari, and then the key event, 3:30 p.m., Atlanta Fed President Raphael Bostic with our own Michael McKee.
Take a break. I just don't think we need it today. I really don't. Wasn't it message received from Chairman Powell?
Well, was it message received? Was this what he wanted? Did he want to juice some sort of rally in the equity market and the bond market?
I don't think he wanted that. No.
He's on the phone to Fidelity or Schwab before. Can you go long Apple, please?
So if they want to walk it back, maybe they could start saying the market received it the wrong way, and maybe we could see some kind of reaction.
I got a call from Rachel yesterday, our manager.
Rachel who?
Our manager. She said, "You sure you want to come back? You know, you can stay off through the weekend and come back on Monday."
He's like, no.
Miss this, please. Steve Whiting, Chief Investment Strategist and Chief Economist at Citi Global Bank.
Whiting was tearing up.
Joins us now. Steve, good morning.
Good morning.
What are you and the team looking for on payrolls later?
Look, I think it's about half of what it was last month. Let's just remember, throw out the COVID period shutdown and the reopening. Just in the last year and a half or so, the range on employment data, even after the revisions, has been from 105,000 to 904,000 on these monthly numbers. And you can see there are deviations from the trend. The trend has been moderating. Here we have 30,000 less. Those will be back, the strikers, in the November report. You know, there hasn't been any collapse in the labor market. It's been a lot stronger than we had thought going into this, and yet we have still managed to take inflation down from 9 to 3.5. So that's good news, and I think there's some acknowledgement that you heard from Chairman Powell that, you know, if everything is overheating, why is the employment cost index decelerating? You know, how did we manage all of this disinflation? You know, how did we manage to get supply and demand to come together in somewhat better balance without knocking the economy into a collapse?
What does bad news look like today?
You know, bad news today would be, you know, some job number like 400,000 that
lots
would
of
reignite,
jobs,
at least for
higher wages,
for the financial market.
Employed America.
Yeah, exactly.
Terrible.
Yeah, I'll tell you, for the financial markets, again, for the economy, the more the better.
So we live in this upside-down world still in financial markets.
You know, again, when the Fed is saying we'll drop the economy into a contraction if we can't align supply and demand, we must moderate. That's what financial markets need.
I'm looking here at productivity yesterday, and I understand off 2 quarters you can't really take a productivity snapshot, but Julia Coronado's led the way on this. Are we completely misjudging the technology overlay and the productivity it leads to this more buoyant American jobs report?
Well, I think that this is a really big issue, and it's going to play out over the next couple of years. Our labor market last year outgrew the economy by the most since 1974. The labor market has been outperforming the economy. The economy has been, there's all sorts of readings below the surface, 12 months of contraction in manufacturing. Very little. Housing, single-family housing constructions collapsed over 20%. And the labor market has been growing very strongly. So I think we're going to reverse that trend. We're going to start to see that cyclical industries come to grips. GDP growth will firm, not quickly, but into 2025, and the labor market's going to stall. And that's going to mean an improvement in corporate profits. It's not V-shaped. It's not collapse recovery that everybody, can clearly see. But I think beneath the surface, we're going to see, again, that profits are going to outperform labor if we look at the next 2 years. And that data point, is what it looks like.
So soft landing. You're basically in that camp.
No, I think I would say this. I mean, do we need, again, massive unemployment to stabilize inflation? I say the answer is no. But a couple of years of below-trend economic growth and stalling out future job gains, is not exactly paradise.
Well, but the problem that I guess a lot of people in markets are grappling with is this is a slow-moving, unknown story of what will be, and markets are bouncing around, and I'm talking about the 10-year Treasury yield at an astronomical levels. The fact that we've gone 35 basis points in a couple weeks based on not a lot of new news gives you a sense of that. So where is the bias in terms of the violent reaction in benchmark yields and stocks today? Is it the upside surprise, or is it a downside surprise that turbocharged the rally?
If you take a look, a lot of investors, if they get really traders, are short stocks and bonds together. There has been, a negative view of how much further tightening we will need, how much the economy must suffer to get inflation down. And we're biased to see a little bit of improvement. Now, we just had a nice big rally in the bond market. It's not going to be a period where we're going back, well, suddenly, rates should be 2 again and growth should take off and inflation 0. It's not going to be that environment. But there's been a tremendous amount of negativity, and we're finding, again, enough reason for us to move a little bit more favorably. For the first time really since 2020, to incrementally add some risk in the equity market and say that this bond yield, by the way, global bond yields ex-US, or at least developed market bond yields ex-US, 3.2%. So there's capacity here with 5.5% investment grade bond yields. That's governments and corporates together, for us outside the United States to really put some money to work here.
Yeah, Jane Fraser wants to know what to do with her portfolio this week, and Whitey's going to tell her to take the cash and buy stocks, right? Is that the short answer here?
A little more.
A little more?
And special. Well, look, I'll tell you, it's not just, large cap tech. We need to outperform whoever's going to be, a little more there.
Regional banks.
Well,
all in.
You want to nibble at regional banks?
40-year lows in bank stocks on a relative basis. Interesting, but we're taking a lower risk approach on that.
Okay.
I would tell you small cap growth cap stocks, mid cap growth stocks, 15 times trailing earnings. Now, the long-term history, 25-year history, is 21 times. So I'm just rounding a little bit, but that's trailing EPS on the piece of the small and mid-cap stock.
It's TV. I don't expect direct answers. Don't worry. Carry on, please.
You wanted some specific advice here.
It's Friday.
Yeah. But think about companies that are not leveraged, that are not trillion-dollar companies. Maybe some of those have been left behind.
Small caps have been battered, absolutely battered since the highs early this summer. Steve, thank you. Steve Whiting.
Thank you.
Over at Citi, Global Wealth, fantastic lineup, ready to go a little bit later this morning. Priya Misra, JP Morgan Asset Management coming up in the next hour. Sarah House, Wells Fargo, we'll talk to her about the last mile of that inflation push. Plus, I believe, Lisa, catching up with Alan Zettner at Morgan Stanley a little bit later.
Who is calling for something of a soft landing, a slowdown, sort of something that can accommodate a sort of softening labor market without a big recession and still the disinflation? That to me is the biggest question, right? Do we still see inflation continuing to go down even with the strength that we have?
I just want to get away from this upside down world we're in.
Good luck.
Treasury yields are lower, the data's a little bit softer, the Fed's backing away from hiking and banks are rallying.
Yeah.
That's not the world that was described to us 12 months ago.
John, it's a different world since you've been gone.
It's a whole new world, TK.
It's a whole new world.
Who's going to sing? Let's go.
Tom, you've got it. It's Stevie Mike's off. Doesn't work.
Last month's jobs report caught everyone off guard.
Major upside surprise on the headline number.
Considerably stronger than people thought.
Almost twice as much as what the expectation was.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Rates are going to have to stay higher for longer, potentially even go higher.
Can there be lasting damage here?
Those cracks are starting to form.
The October jobs report, today on Bloomberg Television and Radio.
The supplemental request that we submitted contains 4 really critical national security urgent needs. Israel, Ukraine, our Indo-Pacific resourcing, particularly when it comes to manufacturing of submarines, and of course border security. All 4 are important. The president wants to see all of them honored, all of them acted on by Congress, all of them together. We wouldn't have submitted it that way if we didn't believe that they all weren't important and should be acted on together. The president would veto an only Israel bill. I think that we've made that clear.
It's the push for more aid. That's John Kirby there, the US National Security Council spokesman. Secretary Blinken speaking from Tel Aviv a little bit later this morning, a couple of hours from now. If you are just joining us this morning, good morning to you all. Check out the price action on the S&P 500, heading towards a big week of gains, the biggest weekly gain potentially of the year so far. We're down just a touch, negative 0.1% on the S&P 500. Yields coming in just a touch as well, down aggressively on the week on a 10-year maturity. The 10-year right now, Tom, 465.54.
Yeah, the 10-year came in, but just as importantly, John, the inflation-adjusted yield came in off this new accommodation, away from restrictive, away from, some would say, market-making, super restrictive. You had a 10-year real yield, and the answer is 2.26%. While you were gone, that got as high as 2.50%. So the inflation-adjusted yield is game-changing for all of America.
Is this a drinking game?
Once a segment.
It's a drinking
While
game.
you were gone,
Yeah.
shot.
Exactly.
Shot. Are we playing that all morning?
Tank.
I'm already
Tank. Okay. Okay. Good to know. TK, I think the Treasury market bulls had some good news this week, didn't they? Wasn't just Chairman Powell. Wasn't just the data. Bramo, it was also the amount of Treasury supply we won't be getting going into year end.
To me, this was the story, and everything else was basically gravy on top of it. And this showed that the Treasury is very attuned to what's going on in market dynamics, and they're going to cater to them. Are they playing the market? I don't know. I mean, yesterday, Janet Yellen really pushed back on the idea that they didn't extend the maturity, saying they're actually longer duration than they have been in decades. But to me, what this highlights is this Treasury market, this Treasury Department does not want to see dysfunctional treasuries.
John, it's real simple. Can we just say it clearly? Tom was wrong. Bramo nailed this with the refunding.
Bramo often does.
Less.
You didn't think it mattered this week?
I didn't think it mattered. I'm like, big so what?
You were lonely.
And
Lots of people did.
All the pros lined up.
Lots of people did.
All the pros lined up behind the toxic brew at Halloween.
Easy to say that you're wrong. Is Secretary Yellen wrong as well? To come out and sit down with Peggy Collins in Washington, D.C. and basically say that this sell-off this year has nothing to do with additional supply, when we've basically heard from the IMF it did. We've also heard from Lael Brainerd, National Economic Council Director, speaking to Anne-Marie and Joe Matthew down in Washington, D.C., that to some extent it matters. And I think we can all agree that to some extent it matters, and we can disagree over the extent, perhaps. But ultimately, that Treasury refunding announcement came in a little lighter, and what happened to bonds?
Massive rally.
So clearly someone thinks it matters outside of Secretary Yellen.
And I would argue that the implicit message here is the Treasury Department understood how much it mattered, which was why they didn't extend some of the purchases and increase them by more in the long
Why
end.
is the 20 years so different? I mean, seriously.
It's less liquid.
It's just less liquid. Nobody owns it?
It's a smaller portion of bonds outstanding.
Because, John, they all moved. They all had a Bramo move.
There is this kink in the curve.
Yeah,
yes, there is this odd kink in the curve around the 20-year maturity. OK, just to wrap things up, Tom, stocks down here by about 0.1% on the S&P.
In Washington, Terry Haynes joins us now, founder of Pangea Policy. Terry, with great cheer for the exhaustion of our Secretary of State, does shuttle diplomacy for Blinken work like shuttle diplomacy worked for Kissinger?
I think it's very different for a couple of reasons. One of which is kind of bubbling under here. Blinken's mission this time, as opposed to the last few times, is designed to try to convince the Israeli government of some kind of pause or humanitarian pause, something like that. And it calls into question a couple of things. It calls into question the degree to which the United States continues to support the current Israeli government. The Biden aides are running around Washington briefing against Netanyahu right now. And secondly, it calls into question whether or not and to what extent the U.S. still supports Israel's war aims in Gaza. And that's a concern. All this also complicates the Israeli aid package, because Congress is not going to pass an Israeli package if they don't clearly understand what administration policy is. So we've got a lot of problems here that complicate Blinken's mission.
Terry, unfair question, but I got to go there. It is in the zeitgeist into the weekend as well. Now, you were there with Lord Kitchener and Mark Sykes when they divided up the Middle East after World War I. I understand that. All of a sudden, we're talking about a partition of Gaza. We saw a partition of Vietnam, a partition of Korea. Is that the easy way out here, is whatever this word means, a partition of the Gaza Strip?
Yeah, there's partition and, it's kind of international administration are all the phrases that go together. These are phrases that go back, as you quite rightly point out, to post-World War I League of Nations mandate-style governance. And they tend to bury the harder realities, which are the nature of the terrorist organizations, the nature of their funding, and what sorts of proxies they are, and they tend to bury kind of regional responsibility for the problem, and all those are going to have to be dealt with, and we haven't even started to deal with any of those yet.
Terry, what do you make about the strife within the Republican Party stemming from Senator Tuberville of Alabama, this idea that he will stall with the the confirmation of some of the military promotions at a time of expanding conflict overseas?
Well, I give you 2 points about that. One is that it is obviously providing some strife within the military, and at the same time, the senator says directly, and to my knowledge has never been countermanded, that he wants to have a dialogue with the Department of Defense about all this stuff and come to some sort of resolution, and that he's not got it. What I think is going to end up happening is this gets resolved somehow in the defense spending legislation that comes up by about the end of the year. One way or another, this is going to get dealt with in the next 2 months.
There was a resolution that passed the House offering support to Israel, but also tying it to cuts to the IRS, which some have suggested would actually cause a bigger deficit because it would reduce tax revenues that the U.S. government gets. Does this progress the issue or actually push it back in terms of the debate?
Well, two things. One is that only in Washington would the IRS get, I'm being rough here, would get 80 billion more dollars and then have it cut by 14 and have that considered by anybody to be a cut in IRS spending. But there you are. Secondly, I think the funding is how Israel aid is funded is almost beside the point. The bigger problem that we have right now really is this. You ran Admiral Kirby in your lead-in. Admiral Kirby says that the administration has 4 priorities and they all need to get dealt with together. Well, these are Biden's priorities. These are Biden's foreign policy. Biden's going to have to get all this stuff done and in a way that is funded properly. And right now, whatever else Secretary Blinken's doing, the apparent change in Biden policy towards Israel is making that more difficult because now Congress doesn't understand exactly what Biden's foreign policy is.
Hey, Terry, great to get your input as always. Terry Haynes there of Pangea Policy. A reference there to Secretary Blinken. TK, he speaks in about 90 minutes' time in Tel Aviv.
It's going to be interesting to see, and as Lisa said, a multiple trip. But, I would say this is a shockingly changed affair that he flies into than it was on the first trip. And it's in real time. And it's like, literally, folks, I'm not sure where we're going to be at 5 p.m. New York time tonight. I'm seeing face-to-face, hand-to-hand combat.
I would agree with that. And I think one of the most underplayed stories and events of today is that 9 a.m. Eastern discussion from Hezbollah's leader, where potentially they could say that they're joining the war or not. And that will mark a key moment in this particular war.
Those comments a few hours away. Moments away, we'll catch up with Sarah House of Wells Fargo, pushing ahead to that payrolls report in a few hours' time. Live from New York City this morning. Good morning. The equity market higher every single day this week, Monday through Thursday. Let's see if it happens on Friday. Your equity market this morning, negative by 0.1% on the S&P 500. On the NASDAQ, what a run so far this week on the NASDAQ 100. Up by more than 5% so far this week, Tom. Just trimming those gains this morning, we're negative a third of 1%.
The search for growth, that's really what the heart of the matter is. David Sowerby, expert on mid-caps, was with us yesterday on Bloomberg Radio. And John, he just said, look, everyone's starving for growth. And it doesn't necessarily have to be Apple, but everybody's got a bad case of growthiness, and where are you going to find it?
This bond market's in search of slower growth. Your 2-year, 10-year, 30-year shaping up as follows. 10-year yields moving all the way back away from 5% to 465.75. Lisa, unchanged this morning, anything but on the week so far.
It's kind of a shocking move. Mohamed El-Erian came out yesterday and was talking about how this is not normal. It should not be normal. This is very disruptive to give people a sense of confidence.
It is disruptive.
At this moment, though, I have to wonder, A, what the positioning is behind this. The technicals start to matter a lot more when you get whipsaw moves like this. But B, does this have anything to do with the data? Or, John, to your point, is this entirely the refunding agreement? And that's going to be a tailwind regardless of what we get today at 8:30 a.m.
I looked at a fancy chart, and the 2-year yield, I believe it was, it doesn't even matter what it is now 1, 2, 3, 4, 5 times made this move, John. And the answer is, do we pull back from here to the gloom that we've had recently, or can we actually break through technically to some new regime?
20 basis point move on Wednesday. Just kind of mental.
Stunning.
Just big moves. We'll catch up with Mohamed a little bit later this morning, around about 9 a.m. Eastern time, so 2 hours and 30 minutes away. Let's round things up with foreign exchange. The euro shaping up as follows against the dollar, 106.44. Lisa, doesn't matter what happens, does it? This currency pair is still a bit of a snooze.
It is a bit of a snooze, although we do have a sense that maybe we're going to see a bit of a reprieve for the solid dollar strength. But again, I mean, basically, just tell me the day and I'll say 106.
Average over the last 12 months, 107. 107.43.
Totally
Just
different.
looking at that right now, we're at 106.44. Under surveillance this morning, US Secretary of State Antony Blinken arriving in Tel Aviv, meeting with Israeli Prime Minister Benjamin Netanyahu. This coming after House Republicans passed an aid package tied to cuts in IRS funding. President Biden vowing to veto the bill. The Senate preparing its own package. Lisa, this battle is going to be going through the weekend potentially.
But it leads to a question, A, how are we viewed outside of the U.S.? We keep going back to this, the fact that we cannot get something passed here in the U.S. But the second question is, how far will U.S. involvement go? And this is the reason why I'm so keyed into that speech by the Hezbollah leader today. Where is the trigger point for U.S. troops to get more intimately involved as all of the tankers and the warships are being piled up in the Mediterranean?
I will put it out on Twitter. It is the read of the weekend for everybody on this topic. It is Robert Gates in Foreign Affairs magazine, the former Secretary of Defense, with a primal scream against the isolationists of America. It is without question the read of the moment.
Very cool. Looking forward to that, Tom.
Yeah,
Give that a read over the weekend. 2 hours away from payrolls, and we've hardly talked about it this morning. If you'd like the estimate, here it is. The estimate in our survey calling for a 180,000 print, with a range of calls from Wall Street's biggest banks.
Michael Gapin is.
Bank of America and Mike Gapin looking for 230. Tom, Goldman 195, Morgan Stanley 190, Citi 160. We'll catch up with Wells Fargo in a moment, 175.
You know, where's the normal run rate here? And I think most people are going to say 100.
Well, they're hoping it's not 336, which, Bramo, was the previous number.
What I think is going to be the most interesting part of this particular report is, let's say it comes out at 230, the Michael Gapin view of the world. Let's say treasuries don't sell off. Let's say yields stay where they are. What the takeaway for me will be is that the refunding message is going to be, the refunding announcement, I'm just going to keep talking, was really the most important thing of all of this, because it's not really in the responding. I'm talking about the yield to the economic data.
Keep talking.
I'm going to just keep railing through this.
That's the skill set that is required to operate on this program.
I know, I'm working on it.
Without just crying every single day.
Well, you could do that too, just when, you know, the camera goes off.
Did you see us go down in flames yesterday?
What happened? I missed
it.
What happened?
We're doing Bank of England. Lisa and I, A, we don't know anything about it, and B, we don't care. Lizzie Burden saved us.
Well, Lizzie's great.
She saved us at Queen Victoria.
Bramo wasn't here yesterday, Tom.
Oh, that was Scarlett. Maybe it was 2 days ago. I can't remember.
But it's okay.
I was here.
I definitely went down in flames yesterday, too.
Let's talk about Apple. falling in pre-market trading after reporting weaker than expected revenue out of China. The company also warning of a sluggish holiday quarter with sales of iPads and wearable products expected to drop. A stock is dropping, Tom. I know you've got a different view on things. 172 in early trading, we're down 3%.
Up 37% this year. Arif Malik put out a 2026 Apple view at Citigroup, and basic idea here is they grow 10%. 10% growth.
Look, I get it. Margins are still good. The shift towards revenue from services, fantastic. I understand all of that. Maybe that warrants a higher multiple.
Yeah.
Fact of the matter is, Tom, the bulls out there no doubt will catch up with Dan Ives of Wedbush at some point in the near term, in the near future. He's been talking about this massive upgrade cycle, Tom, on the iPhone that just is not materialising. It's not happening.
The upgrade cycle is materializing, but the unit growth, particularly in certain things like iPad and that, is not happening. That is 100% true, overlaid with Bramo's concern about China.
Let's be very clear. I recently went to the Apple store. I saw people lining up to drop $1,000, $2,000, $3,000 at one pop. I understand the free cash flow. I understand it being taken out of my own personal bank account. What I'm questioning is just valuations when you're baking in growth at a higher yield regime, and whether it's already up, the stock 37% year to date.
Keep talking.
Uh,
What have we baked in? I'm going to get really good at this.
Keep going.
Is it time for a
This
nerd
is great.
banner?
It is, please.
Nerd banner. Let's
You didn't
do
listen
it.
to anything anyone said.
Atif Malik and his team. Citigroup, Apple, free cash flow. They look out 3 years, 2 years. Pre-pandemic, $55 billion in free cash flow. They're estimating 18 months out, $128 billion. It's a terrible business. I don't want to be in that business.
Stock's a bit softer this morning. We're down about 3%, TK.
Up 37% this year. Sarah House doesn't own Apple. She's senior economist at Wells Fargo, and we get a brief on payrolls today. What is the run rate of non-farm payrolls between OMG, we're fully employed, and OMG, it's terrible out there? Is it 100,000, or could it even be less than that?
So roughly 100,000 is what you would need if you're seeing the participation rates stable to keep the unemployment rate where it is. Now, the Fed is projecting that the unemployment rate is likely to inch up over the next year or so. And if you look at its long-run projections, suggests that it needs to inch up. So in that case, we're looking at an even lower rate, sub 100,000, unless we are to keep seeing the rebound in participation that has been so strong over the past year. Then that's going to push it up a little bit, probably back to 100,000, maybe a little higher.
Who are the people to get us from it's an 100,000 rate to we're actually doing, to pick a number, 170,000? What kind of Americans are those people that are getting the jobs now where we say, well, they really shouldn't be?
Well, we want Americans to have jobs, but when we think of who's driving that rebound in participation, it's been concentrated in the prime age workers, so both men and women. So women's prime age participation, it's at a record high. Interestingly, a lot of that's been driven by mothers, particularly young children, as they're leveraging this remote work environment. But we've also seen a very nice rebound in prime age men's participation. That is linked to some of the increase in immigration that we've seen as foreign-born workers do have higher participation rates, but also just the strength of traditionally male-dominated industries this cycle. So construction, mining coming back, transportation, warehousing, obviously very strong this cycle, and even manufacturing holding in there as well.
See, Sarah, you read my script. Here's a chart, folks. On radio, this looks great. This is the miracle chart of the American labor economy and fiscal stimulus. This is the prime age 25 to 54 employed percent in America back 3, even 4 decades. And the answer here is obviously, Lisa Abramowicz, a huge plunge off the COVID and pandemic. And with that stimulus, with our public policy, you know what? It worked.
And at this point, the question is whether we're going to see some sort of rollover that a lot of people are saying is required in order to get inflation back down to 2%. Sarah, do we have any information really to answer that conundrum, which is one of the biggest debates on Wall Street right now? Do we need not only sub-trend growth, but negative growth and a real drop-off in the labor market in order to get inflation back to the Fed's target?
Well, I think we need at least sub-trend growth, hopefully not necessarily negative growth, although we do think that's still a heightened risk environment. We have seen a lot of help on the inflation front from the supply side, so like the labor supply, which we were just discussing, but also, of course, from the goods side of things. So as we've seen supply chain issues improve, we've seen goods inflation come down from over 12% at its peak to flat now. And so we are seeing that improvement. But I think, in order to get inflation all the way back down to 2%, as we've seen some of the initial help from that supply side improvement, it's likely to also take weaker demand. And that's where that sub-trend growth comes in.
Do you think that Fed Chair Jay Powell is pleased with the market's reaction to what he said yesterday? Or I guess Wednesday?
So I don't think he's probably aiming to guide the market one way or the other in terms of its actual reaction, but just trying to give clarity on where he thinks that the Fed is going as best it knows, or to what extent it doesn't know what their next move is going to be. And he knows that sometimes markets interpret what he says perhaps a little bit differently, or can run away with things. But I think that's not his primary focus. All
right, let's reframe this, because that was very politically correct, and it sounded very much like how the Fed would respond. I guess the question is, was the speech more dovish than you thought it should have been, considering the labor market that you just described?
So I thought overall that it was dovish in the extent that, yes, they left the door open for future tightening, but I think they are more cautious on what's ahead. So now they've held at 3 of the past 4 meetings, even as you had seen very strong job growth in the most recent reading, of course, that nearly 5% GDP number. And so I think they are getting to that point where, yes, he says they're still debating whether they go once more, but really it is becoming more about the duration of how long this hold is. And of course, the financial condition side has played into it, where they're acknowledging that they're watching that more closely by putting that in the statement. And of course, financial conditions have eased since the statement. So it's a little bit of a back and forth, but that's where that duration comes in. They'll just have to hold longer if they're not seeing that pass through in financial conditions.
Sarah, quickly here, fold in the jobs report today with the trends we've seen in claims of 220-ish per week. I mean, it's more weekly data, and I guess it still shows a wonderful job economy, but link those 2 reports together.
Yeah, so when we look at the claims data, so it's creeped up a little bit over the past couple weeks, but overall still very behaved, still very low levels, consistent with the run rate of job growth in recent months, still being very strong. But also important when we think about where hiring goes from here. We're still not seeing a lot of layoffs, so that means that if you are going to see that slowdown in hiring, to get something that is more sustainable, especially if you are still trying to tamp down wage pressure to cool in inflation, that it's going to have to come from, at least right now, more of that demand for new workers. And we've seen that a little bit, but as of yet, still seeing pretty behaved layoffs, which again is leading to this gradual cooling in the labor market rather than that wholesale collapse I think perhaps was feared when the Fed was hiking so aggressively last year.
Hey, Sarah, thank you. Sarah House there of Wells Fargo on a payrolls report a couple of hours away. Phenomenal to still see these numbers. 180,000 is the estimate for today. For unemployment, Tom, looking for that to stick at 3.8%.
Yeah, and not that long ago, it was like 4%, 4.2, you'd start getting sweaty, or, maybe even 4.5. And it's just a whole new regime out there. And now I don't pretend to have any answers, John, on what to make forward of the regime, other than I've got immense respect for people, and I use this with care, guessing about the nation's productivity. We don't know. Anybody who wants certitude answers. Coronado has led on this. She's been absolutely brilliant about saying, hey, what's going on? Is it maybe productivity?
I'm with Bramo on the Federal Reserve. His second line of the statement, second paragraph, just on tighter financial conditions. What matters on financial conditions is whether that persists. And based on the moves of the last couple of days,
not so much.
Lisa, you can unwind that really, really quickly, and all of a sudden that statement looks very, very dated. On Apple, Anna Rana up next.
The iPhone remains like an exceptional product. I wouldn't say the Chinese are going to put out a phone that can compete with the iPhone, but we know that in the past, about 20 million phones were selling at Huawei, and when Huawei disappeared, that market seemed to have moved straight into Apple's hands. And that's a concern.
The brilliant Pierre Ferragu, Global Technology Infrastructure Head over at New Street Research on Apple. Apple a little bit softer, lighter, lower this morning. The stock is down by something like 3% so far this morning in the pre-market. TK, following numbers after the close yesterday. Just in terms of revenue growth, there isn't any, and hasn't been for the last year.
Ferragu and Tim Forte have been the most right on Apple. There's no question about that. And I quizzed him late in that conversation, John, and it's very simple. He's not gloomy on Apple, but he says, does it tread water for 3 years or 5 years? And let's be clear, for a huge part of the Apple fanboy, fangirl community, fangirls like Lisa, I mean, for the fanboy, fangirl community.
Are we describing Bramo as a fangirl of anything?
Yeah,
because
Bramo,
I mean, that's news to Lisa.
Bramo had to mortgage a child after exiting Apple.
I'm not sure that works for Bramo.
But carry on.
But Ferragu's like out 3 years, 5 years, just saying, is this a treadwater stock? And that's a fear to a lot of the optimists.
Johnson's Fearsome Doom. One of my favourite notes comes every Friday. I know Lisa reads it as well. It's from Michael Hartnett over at Bank of America. It's called The Flow Show. And Tom, you'll like this line. Zeitgeist often talks about the zeitgeist. Here's the quote. So much anger, so much hate, yet unemployment is so low. Can you imagine the social disorder if unemployment hits 5%? Yeah. That's why, his view, here's the punchline, that's why policy panic comes early in 2024. That's the zeitgeist in his mind.
Yeah, and I see it out there. And the wonderful Twitter feed Bar Chat, they were just out with a Goldman Sachs chart, which just shows the gloom in the hedge fund business. The hedge fund business over the equity market. And that was part of that short cover the other day. My mic here's, you're moving my mic around,
I didn't move it. I didn't touch it.
You know, okay.
All right.
Maybe too much Bar Chat.
I don't know what's going on there.
Okay.
Let's get to the price action.
Please.
Missed this. Equities right now on the S&P 500, negative by 0.1%. Biggest weekly gains, potentially, of the year so far on the S&P 500. Here are the scores. The S&P so far this week up 4.87%. The Nasdaq 100 through Thursday up more than 5%. TK, that is a solid week of gains on the S&P.
And the Dow up 5.3%.
Were you doing Dow points in my absence?
I'm making it up. We did Dow quotes as well. Let's save the show now, and you can always do that with Anurag Rana. He is truly expert on the cloud and has a partial interest in Apple Computer as well. Anurag, I want you to explain to the audience how a tech company runs their company for profit versus running it just at the top line. To me, Apple is a profit, cash-generating juggernaut. Why is that so odd, so strange?
Yeah, I think that goes back to the foundation of the company. It really believes in having high-margin products. It does not believe in gaining market share. You know, even after all these years, it has only 18% of the unit market share of smartphones around the world. It can completely change that overnight if they drop the price of the phone, but they will never do that because they believe in gross margins more than anything else. Over time, they will gain enough market share in every market, but this is not something that they do is try to gain market share just for the sake of it.
It's a journey, Anurag, as you know. Before we start talking about lower prices, can we talk about the absence of higher prices? Have they lost pricing power?
No, I don't think so. The problem over here is people are keeping their phones for a longer period of time. If you were keeping it, let's say, for an average 3.6 years before, you're probably keeping closer to 4 years. So what that does is it just elongates the time it takes for you to refresh your phones, or for that matter, any other product. So I don't think it has nothing to do with the pricing power. The Pro Max is unbelievably expensive compared to the older models, and it's doing very well.
Clearly, the revenue mix growth shift is moving towards services. Anurag, how does that change your approach to value in this company?
Yeah, I mean, it has been a true surprise to see that number grow, still in double digits. I expected that to be back into the high single digits by now. It has a high gross margin. It has a 70% plus gross margin compared to products, which is in the 30s. So over time, when you see the revenue mix shift towards services, you can expect the overall company gross margins to trend up inch by inch going up. And we have seen that already in the last few years.
Anurag, do you think that analysts are overplaying or underplaying the declines that we saw in China?
I think you have to sit down and think what kind of company this is. And I think this is really evident. And I've discussed this with Tom and Paul many times, that this is not a company that's going to grow sales in double digits. This is at best at this point, mid to high single digit company. And I think people are getting used to that fact. Yesterday, when they guided for December quarter, which the estimate was that it's going to grow about 5%, they said about flattish sales. And that's when the stock dropped. I think people need to come to that point that, refresh cycles are going up, and it's going to be a time before things are going to grow at that same pace.
Which then leads to a question of how much growth, how much future growth is baked into the valuation of the company that's seen a 37% rally year to date.
Yeah, I think valuation is something that we talk about a lot with investors. And, sometimes you have to really ask yourself, is this a technology company or this is a consumer staples company? Because if you take the hat of a consumer staples company, something like a Coca-Cola or a Costco, then you see things with a very different lens, because those companies also are not growing, 8 to 10% top line.
Anurag, I want to look at something beneath the radar this week. It's a Friday, and in the world of Microsoft, it's a different Friday. It's a Copilot Friday. What is the importance of this announcement that Microsoft's making, where we actually do AI with a modeled, marketed program for global corporations? What does Copilot mean to Microsoft?
So Copilot is basically an AI tool that goes with your original software package. In the case of Microsoft, it's launched that with their Office suite, which started selling yesterday. That's about $30 per user per month. And they're hoping that, the serious worker in the office, that's probably somewhere in the 150 million to 200 million people around the world that currently use the Office suite, some portion of that will opt for this particular feature to help gain productivity. Copilot can also be used in writing software. So it is just a tool that everybody has. They are the first ones to come out with it at such aggressive pace.
What's your prediction on this? I mean, come on, you've nailed the cloud. You got a cloud view out 3 years or 5 years, which is just absolutely remarkable. What is your prediction on how Copilot will do?
I think in our view, it's going to be very slow and steady, because the $30 per user, per month is a very steep price. We think, adoption rate is not going to be more than 3 to 5% in the first year of it coming out. So, perhaps a $2 to $3 billion upside on that. On the software coding side of it, which is GitHub Copilot, we think the adoption rate is going to be very high, close to 75%, because I don't see any developer out there that can afford to write code without this tool right next to them.
Anurag, thank you, sir. As always, stock negative in early trading. If you are just joining us, Apple down by about 3% this morning. That was Anurag Rana there of Bloomberg Intelligence. Lisa asked about China. Tom Forte, D.A. Davidson, making 3 points. Here's point 1. Weak macroeconomic conditions in the country negatively affecting sales. Point 2. We see Apple is caught in the middle of escalating tension between the US and Chinese governments. And point 3, the company is still over-dependent on China, Tom, on a supply chain standpoint. 3 points, and we didn't even get to competition there over in the mainland.
Let's be clear, the gentleman from D.A. Davidson has been dead on. He's been the best performing analyst over the last 12 months.
Catching up with him a little bit later. It's cut his price target. 166 from
which is a long way from Dan Ives
so
240.
Lisa, 172 right now.
To me, there are a number of big risks. I think you outlined them well, and Tom Forte nailed it, which is we can't really understand why there was such a bigger decline in the China region than people expected. I believe it was an 11% miss relative to expectations. Is it because of competition? Is it because of slower growth? And then what happens with the iPhone manufacturing in that region at a time where that's kind of massive? What accounts for, 80% of the production or something like that?
In the reports, it's not just a routine shift from China to India. A lot of people that are studying this that know a lot more than us are saying this is problematic. I mean, how do you actually execute moving manufacturing, say, to India?
Before you start buying the Huawei Mate. Is that it? The Mate?
Yeah.
Is it available in America?
Although, hold on. To be clear, it sounds like it's not quite nearly as advanced as the iPhone.
I know.
And the iPhone and the iPhone.
On radio, if you can see this.
Hang on a second.
The majority kind
Hang on
of
a second.
phone.
I'll tell you about it.
Okay, all right.
Hold on. Hang on a second.
Cheers.
Hands start to churn. Hands start to churn.
She goes,
I know.
You.
I know.
I'm brutal.
Coming up in the next hour. Priya Misra, JP Morgan, Alan Zentner, Morgan Stanley, former Fed Governor Randy Krosner, Jeff Rosenberg of BlackRock, all of that still to come on this Payrolls Friday. Your estimate, 180,000. The previous number, 336. Live from a beautiful New York City, this is Bloomberg.
You can't have lasting prosperity if you don't get price stability first.
People are looking for opportunities to come back into equities.
The outlook is for equities to be rallying into year-end.
Corporations are doing better, navigating very tough environments.
We've kind of maybe been swept up in this optimism, but no matter what, that's got to slow over the course of the next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly negative on a session, up big time on the week. Your payrolls report about 90 minutes away. The number, Tom, 180,000. 180 is the median estimate in our survey.
I was surprised in the Fed meeting. We didn't hear data dependent all that often. And the fact is we are data dependent. It's not only what we see in non-farm payrolls, but emotionally for the president and for the chairman of the Fed, it's about the unemployment rate. Come on, we're still under 4%.
Drum roll, your favorite piece of this. You know how it goes. You ready? Good news or bad news? Bram, let's play the game.
Yes.
What does this market want to see this morning?
Blind door number
180, 150, 100. Does it want to see 300 again?
No. Absolutely not. Absolutely. That would be the worst case scenario for markets. Maybe it's a really good scenario for the American economy. But what they would like to see, not too low, because that indicates real cratering, and that would be bad for risk assets. But they want to see, if it were 120, you can imagine there's going to be this incredible rally.
120 is your Goldilocks print this morning.
I think that would be pretty, that would be a real rally kind of inducing number, which is,
Bank
again,
stocks
ironic.
want to see the same thing?
Exactly.
Bank stocks have had a massive week, Tom. That's the upside down world that we live in.
Yeah,
you get softer data, bonds rally, the Fed backs away. All the stuff that you'd think maybe bank stocks might need, but this year, no, because we don't live in that world anymore. Well, bank stocks this week are up big time. Take a look at the regionals.
Well, you were gone on your cruise ship. I was doing a chart on the BKX, the Keefe, Bruyette, and Woods Index, and I used the word grim. It was a grim chart. So I would suggest it was a pop, and dare I say a short cover in the banks off of that grimness. Now, have they all cleared? Gerard Cassidy was on yesterday, and he wasn't willing to say that now. But boy, was he optimistic out 2, 3, 4 years in the banking industry.
I'd love to do a survey and find out if anyone actually believed that I went on a cruise in the last 2 weeks. Me on a cruise.
Well, yeah, I mean,
even if Carnival picked up the phone right now.
It wasn't Carnival, it was Royal Caribbean.
Royal Caribbean.
You were on
Whoever it might be.
Symphony of the Sea.
In the Bahamas.
We will pay you to go on a cruise. I would never get on that boat.
That's not true. There's a price for everything. Come on.
What do you think that price is?
I think it'd be really
Surveillance
high.
cruise. We do
cruise. Yeah, exactly.
Let's talk about Apple in the pre-market. Apple's down about 3%, a little bit softer in early trading. Tom, we know the numbers well at this point. 4 quarters revenue growth absent at the company. Can they turn it around going into 2024?
We've got some good analysis coming up. Tom Forte at Davidson has got a real cautious view. In fact, his target is below this price of 172, and there's others that completely go the other way. China's a problem, but it'll get fixed and up above $200.
Margin's good. Service revenue.
Margin's not good. Margins are great. And Anurag mentioned that the service sector overlay, and it's a nice straight vector. It's up at 20-some%. I can't remember. But the answer is that's all profit. It's like 70%.
Let's turn to stocks. Equities, just negative by 0.2%. We'll go cross-asset, look at the bond market. This bond market's turned around big time, hasn't it? 2 Mondays ago, 5% this morning. Lisa, 465.75.
And I will just say that my takeaway from the Fed meeting, strategically patient is the new substantially restrictive. We're going to talk about strategic patience quite a bit. 8:30 a.m., we do get U.S. non-farm payrolls, as well as ISM services at 10 a.m., but really all eyes are going to be on the labor market. My eyes are going to be on the bond market's reaction to this labor market. What is the sweet spot of just enough softness to lead to an even further rally as people expect the Fed to be done? Today, Secretary of State Antony Blinken is in Israel. The expectation is he will give a press conference around 8 a.m. I personally am more interested, actually, in what we hear from Hezbollah's leader in Lebanon. It is the first time he's speaking since October 7th. He'll be speaking at 9 a.m. Eastern time and could give some indication of the contours of any kind of escalation or not to come. And today, the Fed speak returns. Fed Vice Chair for Supervision, Michael Barr, he speaks twice. Minneapolis Fed President Neil Kashkari. 3:30 p.m. Don't miss this. Atlanta Fed President Raphael Bostic sitting down with Michael McKee. Do they echo what we heard from Fed Chair Jay Powell, which is not really kind of indicating that they had a need to go further? They are strategically patient.
Depends who. Raphael Bostic, absolutely.
Yeah, he's a big...
I think he wanted out a few months ago from the communication we've had. Mike McKee, let's see what Mike McKee thinks. Mike McKee doesn't get a vote, of course. We'll hear from him a little bit later. Priya Misra, Portfolio Manager at JP Morgan Asset Management, with us around the table. Priya, good morning.
Morning.
Talked about those levels in 10-year yields. Amazing. 2 Mondays ago, 5%. We're going higher. Exactly. Here we are, 465. Have we seen the highs in this Treasury market?
I would argue yes. I think if you look at the move in the last month or so, it's been a very technical-driven move. Once we broke that 430, 440 level, it was, a lot of essentially short positions being put on, this narrative built that that there's no demand out there for treasuries. What we saw this week was we saw some softer data. We saw the treasury essentially responding to the move. The treasury actually cut back some of that long end supply. And we heard from the Fed that the bar to hike further is high. This vigilance and caution from the Fed, they're sort of bringing up this whole lag story back again. So they're waiting for the long and variable lags to play. So I think for us to break 5%, we really need that narrative to come back that there's no demand. I would argue the highs are set. How low can the 10-year go is all going to depend on how does the economy, fare in terms of those lags essentially coming back.
And link it to the 2-year, the vanilla spread, the difference in yield between the 10-year and the 2-year. You more than anyone called the magnitude of inversion what you would see. Where are we now? Have we disinverted to where Priya Misra says this is wonderful, or do we need to disinvert more and even go to a positive difference between the 10-year and the 2-year?
I think for it to be really positive, it has to be driven by lower rates. And that's going to need the economy to show signs that that monetary policy is extremely restrictive. I think that's what results in the next 100 basis points of steepening will be through lower rates. But I'm glad you bring up the 2-year. I mean, all this talk about the market pricing in significant cuts, we're only pricing in 125, 130 basis points of cuts. So what the market's telling you is that they're pricing some easing, which would be consistent with a soft landing. The market is not at all pricing in the risk of a hard landing. I would argue it's 10%, 15% chance, this bimodal world, that there's a very small percent chance of a hard landing, because in that scenario, the Fed is not just stopping at 4%. And what the Fed funds curve is telling you, that the market's pricing in the Fed funds rate to be above 4% as far as the eye can see. That's essentially what the bond market's telling you. No hard landing, that the Fed's going to never cut rates below 4%. I think that's highly optimistic. If you look at the tightening in financial conditions, you look at the cracks that are developing, I think there's a decent chance that the Fed may have to cut a lot more. They don't want to acknowledge it. They're not even thinking about cutting rates. At some point, they're going to have to acknowledge that they may have gone too far.
What we're seeing right now is a lot of people pointing to the refunding announcement as driving a lot of the reaction, particularly on the long end. The front end may be a little bit more tied to what we heard from Fed Chair Jay Powell. Has all of the action in benchmark rates, at least on the long end, been tied to supply?
So I would argue the narrative is certainly there that there's too much supply. I would say the issue was demand. The demand side went back. We know that the U.S. has this unsustainable fiscal trajectory. There's a lot of supply coming in. But if the demand is there, then at some clearing level, the two meet. What happened in the last month or two is that the demand side pulled back. Because if the Fed's going to hike a lot more, if the data remains resilient, then where is that clearing price? I think what we saw is if the Fed is done and if the Treasury is responding, I think the bond market spooked the Fed, spooked the Treasury, spooked risk assets. That's normally a sign that the move is done.
Is the spook over in terms of giving you confidence to go in?
I think yes, I would say the market spooked enough for me to have confidence that we've near peaked around 5%. For us to say that we're going to 3% or 4%, I think for that we're waiting for data. I think we might stabilize between 4 and 5% right now. if it turns out that the economy is actually a lot weaker, then I think we can absolutely move lower. But we could essentially range trade for some time.
How do you fold the events which we've barely talked about this week with all the distractions of, say, euro yen out to 160? How do you fold the confidence that the Japanese will show up at the margin to buy our full faith and credit paper, given the failure of YCC?
Right. I'm glad you bring up global rates for a couple of points. The BOJ was a pretty big deal. I think central banks this week, I would say in October, have been essentially a vol killer. I was nervous around the BOJ because if they just drop yield curve control, that would inject a lot of volatility into the market. The BOJ said, no, not so fast. We're going to be really slow in terms of how we're going to let yield curve control go away. So I think that reduces vol. You have central banks. I would argue October was the first month in many months that no central bank hiked rates. So I think now we look at global divergence. We do think, there are countries like Canada, the UK, where the transmission mechanism or the lags are much shorter. They're already weakening. The US has been more resilient. I would argue the lags will just play out here as well. So I think some of this divergence or US exceptionalism that we've been dealing with for the last 2 years, some of that's going to go away. That hedging cost that you're talking about, Tom, I think that hedging cost goes down and it brings foreigners over time back to the treasury market.
You said the bar for hikes had got higher as the bar for cuts got lower.
I don't think so. I think the Fed is probably traumatized by what happened in terms of inflation. I think they've lost some credibility. So I think the bar for cuts is also very high. And that's going to be really tricky for the market. We've been used for the last 20 years for the Fed to respond right away. I think financial conditions tighten. They may not hike a lot more, but at what point do they ease? I don't think they want to ease financial conditions significantly. So I think we may be in a period of high volatility where we wait and see where's that strike price for financial conditions.
This is what I'm trying to figure out going into next year. What am I looking for?
I think if the data holds up, the Fed is going to be extremely reluctant to cut rates. Even if financial conditions ease. I think if the data falls off, then the Fed can say, well, actually, the unemployment rate is rising significantly, which is why, they may have to start to ease. I think it is going to come back down to the data. I think the data will drive, data dependence will come back in terms of when the Fed eases. But that inflation is just annoyingly for the Fed, staying a little bit sticky. And if it stays above 2%, that bar, I think, to cut remains high.
It tells you something's changed, though. The fact that we just had close to 5% GDP in the third quarter, and Bramo, we didn't get a move from the Federal Reserve.
And they seem to indicate that the risks are still balanced and really emphasize the need to remain cautious, strategically patient.
It's amazing how the tone shifts in fixed
What
income.
is
35 basis
strategically
points
patient?
later in the other direction. What was that,
Where
Tom?
did strategically patient come from?
I think it's just
While
a new
you
phrase.
were gone. No, it's a new phrase, John.
It's a
While
new
you were
phrase.
gone.
Proceed carefully. Strategically patient.
Wait for data.
I think that's called, what do they call that? Strategic ambiguity.
Strategic ambiguity, yes.
Strategic ambiguity.
It's a strategic pause.
Yes. Okay. Priya, thank you. It's good for the update.
Thank you.
Priya Misra there.
Thank you so much.
Of JP Morgan Asset Management. If you are just tuning in, welcome to the programme. Your S&P 500 negative here by 0.2%. Yields are going absolutely nowhere on a 10-year, 465.75. Crude, 82.66. You can guess the world. What's it going to look like? What's going to happen? And then you can get the market wrong. Crude in the month of October. Bramo.
To me, actually, one of the most interesting things that any guest said was Amrita Sen. And she said the reason why we haven't seen oil prices pop, and she'd been expecting $100 a barrel on Brent going into Halloween, she said it's because of demand. It's not there in the same kind of way, even though you might get some sort of supply constraints based on what's going on in the Middle East.
Crude down 11% in the month of October. Down 11%.
Yeah, while you were gone, John, I was looking for a 79 handle on West Texas Intermediate. We never got it. We didn't get to 79. But could I have said anywhere within October that we would get to 79 on American oil? No way. And yet there's where we are.
If you're playing the drinking game at home, if you were gone, you are drunk at 7:13 Eastern Time. How many times are you going to do this when you were gone?
Up until I talked to McKee.
When you were gone.
Rarely, folks, rarely does Michael McKee come out and say, guys, this is important. He thinks Detroit and Dearborn are important. The on-strike statistic for Mike McKee today is 48,000 workers.
I actually just got a message saying that they thought that you had gone to join the United Auto Workers Union based on some of the contract negotiation.
What's more believable, that I joined a union or went on a cruise?
I'm not sure.
Come on. Nadia Lovell, UBS, in the next hour on this Payrolls Friday. Your estimate, 180,000 from New York City. Good morning.
Last month's jobs report caught everyone off guard.
Major upside surprise on the headline number.
Considerably stronger than people thought.
Almost twice as much as what the expectation was.
Today, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Rates are going to have to stay higher for longer, potentially even go higher.
Can there be lasting damage here?
Those cracks are starting to form.
The October jobs report, today on Bloomberg Television and Radio.
Israel doesn't need a ceasefire. It needs its allies to cease with the politics and deliver support now. And that's what we're doing. House Republicans plan to do that. We're going to do it in short order, and it provides Israel the aid it needs to defend itself, free its hostages, and eradicate Hamas, which is a mission that must be accomplished. All of this, while we also work to ensure responsible spending and reduce the size of the federal government to pay for that commitment to our friend and ally.
That was House Speaker Mike Johnson. Some division down in Washington, D.C. over those comments. We'll be talking about them in just a moment with Bloomberg's Anne-Marie Horden, our chief Washington correspondent. I want to talk about a couple of names in this equity market. We'll start with equity futures. On the S&P 500, we're negative by 0.2%. Here's a name for you. Maersk, the shipping company, is down about 15%. This line on subdued demand, not just into next year, but maybe over the next few years. TK, job cuts, they're going to continue a subdued environment over the next 2 to 3 years. The stock is down 16%.
It's really important, and this is basically FedEx on steroids for our American audience out of Copenhagen, and with all the heritage that they have of shipping worldwide. Think of the logistics of UPS, the logistics of FDX. This is a global statement on what's out there, and it alludes to what the IMF has said about global growth out to 2028.
These are the opposite headlines, Lisa, that we were reading maybe a couple of years ago. Overcapacity. We're now talking about overcapacity. That gap is growing in shipping, according to Maersk this morning over in Europe.
That was exactly the right point to pick up on, John. I think that what this highlights is a shift from 2021 and 2022, when there were record profits on the heels of this demand for goods with the pandemic. There is a larger question here. We've got to parse through it. I don't know the answer. How much is this an unusual below-trend kind of trade due to all of the rejiggering of supply chains versus just some sort of reversion to normal?
You put it all together, subdued demand for Maersk, really bad data numbers coming out of Apple on China. Demand a bit softer, Bramo. I'd point out ISM manufacturing earlier this week as well. That wasn't a pretty print from the ISM this week.
That actually turbocharged the move that we got from the refunding agreement earlier that morning. I think that what you're talking about, though, is right on. We are seeing diminishing growth. But to what level, right? What is the new normal? And I think everyone is grappling with that. We heard that from Priya Misra talking about how far do yields go down? How slow do we see this slowdown really escalate to?
And plenty of reasons to worry in the fourth quarter. This bond market's turned around big time. Let's look at the scores. 2 Mondays ago, I've said this a few times already this morning, 5.01% on a 10-year. Your 10-year right now shaping up as follows. We're back to what? 460, Tom? 465.12 on a 10-year this morning.
To be clear, the equity markets really don't pull back. I mean, up 1 day, up 2 days, up 3 days, and you'd think we'd give up more here on the tension of the jobs report and all. Futures -7. I mean,
it's
that's
not
noise.
much of a move. I mean,
yeah, it's noise.
Given the weekly move we've had, Tom, the S&P up by something like 5%.
Well, we go to the jobs report here in an hour and 15 minutes. Right now, on a war and a conflict, Lisa, I think, is really right to focus on Hezbollah and maybe what we hear from northern Israel, southern Lebanon today. We get a brief from Anne-Marie Horden, our Bloomberg Washington correspondent. This was the Secretary of State in Israel. Anne-Marie, I'm going to use these words with great respect for the nuance and the horror that we're all seeing. In your world of the Beltway, as we just heard the Speaker of the House, is this perceived as like a war? Is it perceived as a conflict? Or is it perceived as something I can't make up?
I think it's perceived as a war at this point, and this goes to show that Congress yesterday, the House of Representatives, passed this bill, more aid to Israel than even the president had requested in his original supplemental. Of course, there's a lot of politics attached to this, even though you did have about a dozen Democrats vote for it, very heavily Jewish districts, definitely want to send that aid to Israel. But it comes with this rescinding of cash that's given to the IRS. The CBO already says that this would add to the deficit. Maya McGuinness was on yesterday, and she said this just doesn't check out. So it is dead on arrival in the Senate. The president has already said he'd veto it. But it does give this new speaker some momentum and a win for him to be able to show that he can work with his caucus. This is the first big test for him. And then at some point, they're going to have to figure out how they're going to pass this bigger package that the president would actually sign.
In January of 1942, Anne-Marie, did we link World War II Defense Department, War Department funding with what we're doing at the IRS? I mean, this is a whole new world for Washington, isn't it?
Well, this is why Democrats specifically are saying we cannot set this precedent that every time there is a need for an urgent request for money, whether it's to help national security partners around the world or it's to help with, say, a hurricane in Florida. We cannot set this precedent that there needs to be a pay for in the budget to offset this when there is an emergency request. And that is why there's a ton of pushback from the White House, from Senate Democrats, from some also as well hawks in the Republican Party, especially on the Senate side, that this is just not the path forward when you want to send money to your ally.
Meanwhile, we've seen a real shift in tone from President Biden over the past couple of days, really emphasizing humanitarian efforts, but also protecting civilian lives in Gaza at all costs. Supposedly, that was one of the key measures that Tony Blinken is going to emphasize as he speaks with Israeli leaders today. What do you think is driving that shift in tone? How much is that tied to the divisions within the Democratic Party?
I think it's two things. I mean, everyone is seeing these horrific images of civilians, especially children, that are dying by Israeli airstrikes in Gaza. And what the president says that he wants a pause because these individuals, Palestinians living in Gaza, are really suffering in terms of not getting humanitarian aid. You know, I read the UN reports every morning and the situation is dire. So the president is calling for a pause, and why it may sound like semantics. What's the difference between a pause and a ceasefire? A ceasefire means an end of fighting on both sides, and usually it means a path towards a political resolution. A pause allows for, depending on the geographical location, the scope, the timing, that there will be no fighting so that humanitarian aid, food, medicine, those kind of supplies can get in. And I think that's the message Secretary Antony Blinken is bringing to Israel today. He's meeting with the war cabinet, meeting with Benjamin Netanyahu, but the Israelis say there will be no ceasefire. And then domestically, the president is under a lot of pressure at home from the progressive wing of the Democratic Party and also constituents in places like Michigan, the Palestinian diaspora, Muslim Americans who do not want to see more aid to Israel. And this is why this is an incredibly difficult thread for this president to really try to needle through.
When you talk to advisors, to the president, to the Democratic Party, how worried are they about the fragility of his ability to be reelected based on some of the loss of support over the past few months?
Everyone will tell you it's just way too soon. We're about a year's way, almost, a few days left to marking the 1 year into the presidential election, and they will just say it is way too soon to start talking about how this is going to impact next November. Obviously, we have heard there are concerns when you talk to congressmen and women that represent these districts, but it is still a long way off. Where are we going to be with this conflict November of next year? No one knows right now. What Antony Blinken said before he got on that plane to head off to Tel Aviv was that they want to do everything they can to deter a wider conflict. And that's what this administration's focused on. If they can do that, they're in a better position next year.
MH, thank you. Anne-Marie on the latest down in Washington. Difficult to project things out to next year, Tom, but ultimately let's make a judgment on where we are right now. Maybe even an observation. The world coming towards Nikki Haley Tom, on the Republican side over the last few weeks.
Yeah, I would agree with that. I think it's just joined in away from the actual war news that we're seeing in the Eastern Mediterranean, but certainly she's had a better October than many, I guess is how I'd put it.
You remember that moment in 2008 when the financial crisis hit and the world moved away from the late Senator McCain in that race against Obama? It became about a financial crisis and no longer about his foreign policy.
Yes.
Things can change. Things can change really quickly.
They can change quickly, but again, as Anne-Marie Horton said there, it's such a long campaign. I yearn for the British process.
Well, 6 weeks over and out, something like that, a couple of months. I know. Ellen Zen and Morgan Stanley coming up shortly on this payrolls report. About an hour away, your jobs report, the estimate 180K from New York City. This is Bloomberg. As things stand, biggest weekly gain on the S&P 500 back to November of last year, up by 4.87% over the previous 4 days, up every single day this week, down on the session this morning. We're negative 0.1% on the S&P, futures negative on the Nasdaq, down 1/3%. So far this week, though, the Nasdaq up by more than 5%, TK. A weekly gain through Thursday of 5.21% on the Nasdaq 100.
Starting right out at 2 p.m. there on Wednesday, and it's just the lift has been tangible and really persistent. And again, I'm going to go, well, there is the Dow just went green in the screen, SPX -6 right now. And, you got to see at 8:30 where we go, as Priya Misra said, we're data dependent. So we're going to be data dependent here. I can't make any kind of guesstimate of what happens at 9:30.
Jobs report, 60 minutes away. The opening bell, 2 hours away. The bond market looks like this. The 10-year in the 460s-ish, 465.
Nice-ish. Yeah,
Thank you.
Very
ish. Backing away. A whole lot of ish. Away from
by
2 Mondays ago.
By 9 a.m., you'll be on ish.
Bramo, 5.01%, pushing 5.02 only a couple of weeks back.
I can't imagine that anyone is looking at the whipsaw action and feeling comfortable. Does this give buyers a sense to really come flooding in? How much do we need to get some sort of downside surprise in the payrolls number for people to get conviction that yields are going to go material lower? And this is sort of the fun discussion of good news is bad news that we have to play around with and parse out. It's just fantastically fun to explain why it's a good thing that more people are not getting jobs, because it seems completely counterintuitive and against everybody's gut instinct.
If you are a bond market bull, that's what you want to see.
Exactly.
And everything the bond market bulls wanted to see this week, they've seen, haven't they?
Basically, they've gotten everything that they've wanted.
So far, so good. Payrolls, 180K. We'll talk about the estimates in just a moment. Let's talk about the FX market. Foreign exchange, the euro. The euro at about 106.50. The dollar back to 105, Tom. Started the week at 106. Back down to about 105.897 right now on my screen.
As you mentioned earlier, the euro is not much movement there, but I'm sorry. I got a 159.95 on euro yen. That's where all the focus is among global Wall Street. And again, we've got to remind ourselves, the Bank of Japan and the institutions, they have until Sunday evening, our time, to try to make a decision on this as they stagger into next week.
The euro at about 106, the DXY dollar index at about 105. Under surveillance this morning, Israeli ground operations in Gaza continuing overnight. Troops now encircling Gaza City. The Israeli military saying a ceasefire is, quote, not on the table. As US Secretary of State Antony Blinken making his second visit to Tel Aviv since the war started nearly a month ago. At least we're expecting to hear from him in about 28 minutes' time.
This is the other counterintuitive point, that the markets are basically ignoring this to a large degree. Maybe it's putting a damper on risk appetite. But to me, all eyes very much on whether there's an escalation, and we will get a better sense of that when we hear from the Hezbollah leader today, the first time they're speaking, going back to October 7th.
So that's a few hours away, right?
That's at 9 a.m. Eastern, yeah.
OK, and Secretary Blinken at about 8 a.m. Eastern time, so about a little less than 30 minutes from now. Let's talk about the payrolls report. 1 hour away from that October payrolls report, expected to slow to about half of September's blistering pace and show a cooling off in the labour market. Economists projecting the US to have added some 180,000 positions in October, which would still be above the pre-pandemic trend in job growth. We've been spoiled, Tom, with numbers like 336 in the previous month. 180 is still pretty solid.
It's like managing money right now. Guessing non-farm payrolls is always sport in post-pandemic. I mean, literally, everybody but Ellen Zentner is making it up as they go. And the answer is, do I have a guesstimate here? Do I have any confidence in what my guesstimate is here? Absolutely not. Overlay that with Michael McKee's 48,000 UAW people that you sort of like get the number out, and then you've got to take a 47.
Add them back in?
Yeah, add them back in.
Okay.
Maybe.
Jobs report about an hour away. Let's turn to our last story. A jury convicting Sam Bankman-Fried of a massive fraud that led to the collapse of his FTX exchange. Bankman-Fried facing decades in prison, Tom, after being found guilty on 7 counts of fraud and conspiracy. Prosecuting US Attorney Damian Williams saying Bankman-Fried, quote, perpetrated one of the biggest financial frauds in American history.
This was wow for me. I was taking a surveillance nap. You wake up at, 8:30 last night, whatever it was. They didn't even have time to call out for pizza. It was a 4-hour deliberation. And in the modern day, people expert on this can talk about how much longer, more fractious juries are. America is sealed in our memories. Henry Fonda, 1957, 12 Angry Men. They argued for 3 days. They didn't even get to pizza with this jury deliberation.
There's a question around this trial, and then there's a question around, is his conviction good or bad for the crypto industry? And I think that's going to be debated for a long time, at a time where people are still seeking legitimacy, even though the specter of fraud is now looming that much more greatly over it.
Let's be clear. He has a right to appeal. So, we'll have to go through the appeal process.
You mentioned a timeline. It's amazing how quickly this has all come together.
Yeah.
How quickly it collapsed, how quickly the case came together, and how quickly they executed that case, Tom.
Look to Bloomberg Crypto for this. They'll have a lot more on this, also on Bloomberg Technology. It is Jobs Day, and we begin with Ellen Zentner, Chief U.S. Economist of Morgan Stanley. Her boss, Seth Carpenter, was with us the other day, and we spent most of the time talking about your research. How hard is it right now to take the Zentner Excel spreadsheets and guesstimate 8:30 this morning?
So it is better than a guesstimate, but you can almost lick your finger and stick it in the air to see which way the wind is going to blow, right? Yes, that's the surveillance way. Look, as John said, right, it's still a big number, even though it's half of the pace of the prior month. And that's without adding in the strikers, right? If you add back the strikers, it would be an even bigger number. But here's why it can be a perfect report. Big payroll number, slower wage gains, higher unemployment. That would be a perfect report. And notice that's the way Chair Powell and other Fed policymakers described the September blowout number. Right? Better labor supply, better balanced labor market.
Do you think that based on what we've seen over the past few weeks and the data that's come in, a soft landing is more or less likely?
I think it's still just as likely as we've seen it before. I mean, we are seeing pockets of weakness, right? We talk about credit card delinquencies being up, especially for younger and lower income households, auto delinquencies being up. That's normal as you get later in a cycle. And I always watch to see that that doesn't spread out to other consumer products or start to march up the income chain. While we're seeing jobless claims remain very low, right, continuing claims are rising. So people are not getting reemployed as easily. So there are pockets of weakness here. And it was all over the Beige Book, which informed the Fed meeting, right? And it's all anecdotal. But the Fed knows, and we think we know, it's going to start showing up in the data.
What's more important, the backward-looking labor market report or the fact that in the earnings of Starbucks and Chipotle, people are still willing to pay $7 for lattes and $11 for burrito bowls and are buying them in incredible amounts?
Yeah, so I think when you tie the labor market to consumer spending, obviously labor income matters for most Americans, and it has been slowing. Right, slower wage growth, but still robust job gains. The growth rate in labor income is slowing. But the discretionary spending, and especially on the upper middle to wealthy households, is still very strong. And as long as we're creating jobs, that demand for coffees, we used to follow coffee and sugar over the business cycle. And when coffee and sugar weakened, you knew that we were getting to the end of a labor market cycle. So it's good news that we have a strong labor market, and guess what? We're still reporting to work each day and having that coffee, and we're willing to pay for that specialty item.
I want to go Angus Madison on you. Have we had a demographic shift where we have to get used to a reset and the unemployment rate lower? I look at Topeka, Kansas, 2.9%. Clearly the run rate before was a higher number, 3.54%, whatever the conversation is in the heart of Kansas. Do we need to shift down, almost like we're arguing about our STARD, do we need to shift down our unemployment rate to a new level because of demographics?
Well, I think that there's plenty of argument of why full employment can be had at a lower unemployment rate. But where is that unemployment rate, right? Full employment, R-star, potential growth, these are made up numbers almost. And how do you know you're at neutral for the interest rate? You don't. You know it probably when you passed it up and you get a disaster on your hands. That's how you know where the neutral rate was. So the Fed believes it's around 4% for full employment. That means that we've got a tight labor market.
Okay, but is that a theory? Is that as goofy as a plug-in like our start? I mean, 4% is normal. Says who?
Right. So is it as goofy? Again, these numbers, it's trying to put economic theory in practice. And theory would tell you that the demographic shifts, the fact that companies are labor hoarding right now, that you can have full employment at a lower unemployment rate, which means we're not as tight as you'd think, right? But it's in theory. You don't know. In practice, you know if it's a very tight labor market, if suddenly wage growth is spiraling out of control, for instance.
A lot of people have been talking about artificial intelligence this year. I don't think we're going to see it necessarily in these numbers, but it really underpins the angst that we've seen in some of the strikes, whether it's the UAW or whether it's in Hollywood. How are you modeling out whether this means that fewer people are going to work because everyone's going to be replaced by a robot? Are we starting to see any of that in the data right now?
So I think AI is an exciting trend. I think it's something that is difficult to pinpoint in real time. I think that we are very encouraged that it can alleviate some of the pressures from the shortage in workers in semiconductor industry, manufacturing workers. We just don't have a deep pool of manufacturing labor. And so the more that we can tech out facilities and build more manufacturing facilities that are higher tech, you're going to create a lot of job opportunities in that area, and you're going to alleviate some of these shortages in other areas, right? So I think of AI as a technological advancement similar to periods in the past where there's a temporal problem. You're going to have displaced labor in the short to medium term, and over the longer term, you're going to see labor really increase in other areas.
Let's talk about the short to medium term and theory. You mentioned theory. Does Chairman Powell have one? And if he doesn't, is that a good or bad thing?
Well, his theory is probably a little more tangible than basic economic theory, and that is the data is going to tell me what to do. And yes, there are data that's lagged, but I'm nimble. I can move quickly. I can bob and weave with the data when it comes in, right? And so that nimbleness is something that that I believe he felt confident that he achieved in 2018 going into 2019 when the Fed pivoted very quickly and moved to the sidelines and started to cut. And it looked like things were stabilizing, and then COVID hit. So you've got a chair that should be very confident that, hey, I've done this and I can do it again. And do it again in order to maintain a soft landing in the economy.
Alan Zentner, thanks for your view. Alan Zentner of Morgan Stanley. If you are just joining us, welcome to the programme. We are counting you down to that payrolls report. The median estimate in our survey is 180,000. The price action going into it looks like this in the bond market. What a turnaround we've seen over the last couple of weeks, from 5% moving back on a 10-year to 463.87. We're down 2 basis points. In the equity market, we're negative here by 0.08%. The equity market this week, Tom, up big time, in line with this rally we've seen in the Treasury market as well.
A big time, and the way it's up is great. What I've been trying to do is get a gauge here on where people are positioned. And I get different readings. I don't have a strong opinion on this, other than to say there are select charts that show there's a lot of people that really don't want to be in the market. I wonder how that changes the tone.
Well, I take your point. A lot of this does have to do with positioning and how much of the short positions in treasuries has been wiped out and sort of set a new slate for whatever is to come. And I take your point also with positioning and the bearishness. Michael Hartnett, who you were talking about earlier, John, came out and basically said, well, it kind of looks like we could get a rally. And he's been bearish all year, and yet he's seeing the underpinnings of something into a year-end rally. So not a lot of bearishness. I'm just saying the gloom is not that gloomy.
But then the question is, does that have enough inertial force to break out through support or resistance, depending on which way you're going? I haven't seen evidence, and maybe the reading over the weekend will be, give us some color on that, particularly after the jobs report of, okay, now what? And do we get going? My basic answer is we're off the October lows. I mean, a guy like John Stolfus, these bulls, Ed Yardeni, John Stolfus, and the others, they look awfully good off October.
They're less constructive, Tom, over the last
Yes.
Both of those individuals that you named. It's amazing to see this tone shift, though, 35 basis point move on a 10-year yield lower, and all of a sudden there's reason to be bullish here.
Exactly. I mean, basically.
That catches my eye. I thought this bond market had become de-anchored from all of the stuff that was anchoring it over the last 10 years or so.
Yeah, well,
and you get a 30 basis point move and it's all good again.
And everybody's like, fine, it's stable. We've seen peaks.
I mean, I'm not
for now
being snarky. I'm just catching up because I've been away for a week.
Oh, you were away.
And the world's
for 1
changed.
week, which we're going to talk about quite a bit. We're going to talk about that full block.
Payroll's just around the corner from New York. This is Bloomberg.
The labor market is becoming much more imbalanced. Labor force growth has picked up. It's a very benign story about how this has all played out. It's basically a story where the Fed really hasn't had to do that much to bring inflation down, and the Fed basically is saying, we don't think we're going to have to do much more from here.
Others saying they're done. That was the former New York Fed President Bill Dudley. Citi's Andrew Hollenhorst, base case, the Fed is done hiking. That's a change for Citi in the last couple of months. From New York City, can you down to a payrolls report about 44 minutes away. Here are the scores going into that on the S&P 500. We are negative by 0.08%. Yields are lower by a couple of basis points, 463.46. The dollar is weaker. The euro stronger, 106.47 on that currency pair. And the data in our survey, median estimate, Tom, 180,000 for payrolls a little bit later.
And again, that $48,000 plug-in that Mike McKee talks about with Stryker's UAW, we'll have to see how Mike plays that at 8:30. John, I'm just going to say in the equity market, these are ever so slight movements. There's a little bit of a lift. Fractional lift to the tape right now. There's a little
Turn
bit
around
of
for
a
Apple as well, Tom. If you have a look at Apple in a pre-market, just take a look at the charts. Session highs, Tom, we're down about 2% at the moment after those numbers yesterday.
Yeah, and this is a raging debate. I believe Tom Forti's with us coming up, and he has been absolutely spectacular on Apple, so we'll have to see what he says.
9:45 Eastern Time.
He's at 9:45.
He is, yeah.
Was this the Open? I can't
on Bloomberg
keep track
TV,
of which
the Open, with Jonathan Ferro.
Okay, it's very good. 40
my
with
voiceover
Jonathan
for
Ferro
myself.
would be a
Does that
good
work?
thing.
We can make that happen.
No, it's good.
Right.
We'll simulcast it or whatever. It'll be good. Forti's been dead on here, looking at a number, frankly, lower than this 170 level. It was Fed Day. John wasn't with us. Lisa and I were on the desk, and Bill Dudley came on, and I read the Dudley essay.
You can tell that I've been off sick. You know, at times I sound like a character in a Guy Ritchie movie sometimes this morning.
I didn't know who's Guy Ritchie.
voice is just...
Anyways,
so
Bill Dudley's on.
And
doesn't care.
Can we continue? Thank you.
Please.
Bill Dudley has a scathing essay out on the move to a soft landing and a dovish tilt. And all I said was we need to talk to Anna Wong. She's a chief U.S. economist for Bloomberg Economics, and no one looked at the magnitude of the move to higher interest rates. No one like Dr. Wong. And I thought of you with Bill Dudley, and you know, I don't want you to say that this is what's going to happen, but Bill Dudley worries about being terribly wrong if we pause or cut rates. Can we screw this up that bad? Do you agree with Dr. Dudley of the New York Fed that we could get this terribly wrong?
Yeah, I agree with Bill. So when the 10-year was surging a couple of weeks ago, I did put out a piece that says that if the Fed is acting more like a risk manager, then they got to be thinking about whether they're confident that this surge in 10-year yields is going to sustain. Because whether a substitute for needing to hike more depends very much on whether they believe this increase in surge in 10-year yields would be sustained. And, you know, just when Powell was speaking a couple of days ago, this 10-year fell. So I think what that means is that if they are acting more like a risk manager, they probably should be doing more hikes. And then if indeed inflation does not increase again and does fall, then they can just cut more sharply. So that would be what a really cautious central bank would be doing rather than pausing preemptively.
Right. As you know, the financial media is on the y-axis. We're looking at the drama of cuts and, you know, accommodation and restrictiveness and all that. There's the x-axis. And Anna, take us out to the June 12th meeting of next year. I mean, is that what's going to solve this for everybody, is just start looking for truly a longer period at these levels?
Well, June 12th next year. Wow, Tom. So it depends on I think the swing factor right now is the labor market. And I think that the jobs market is actually weaker than what many economists are saying. Today, we're looking for a rise in unemployment rate. It may not happen today, but honestly, but it will happen in the next 2 months in our judgment. So I think we're close to that nonlinear jump-off point in unemployment rate, where thereafter it will keep going. So by June of next year, we may have an unemployment rate that's higher than the Fed's forecast of 4.1%. And in that case, the Fed would be cutting. But then again, recessions usually are not, it definitely will put a damper on inflation, but you cannot count on recessions for doing also all the work. So if by that time we have a broadening Middle East war and oil price increase, then you will be facing a stagflationary economy.
Which we hope we don't see. But Anna, when you talk about the potential job losses, the non-linear jump up in the unemployment rate, where in particular in the labor market do you think those cuts are going to be felt most strongly?
Manufacturing. So in the academic literature, people have found that even though manufacturing sector accounts for but a very small portion of GDP, less than 30% of GDP, the layoffs and the cyclical dynamics actually drives business cycles. And we are already seeing in this week's ISM report, what really shifted in this ISM manufacturing report we saw this week was that people are talking about using layoffs as a headcount management, whereas in the past, the comments were more like using attrition as a headcount management strategy. So I think that once again, just like in other recessions in the past 50 years, it would be manufacturing jobs that will lead the way to layoffs.
If we could just get a sense of where we're going back to. We saw Maersk report earnings this morning talking about cutting jobs because of a decline in some of the expected trade that they were operating within. Are we seeing a return to normal? Are we seeing something more with respect to the manufacturing sector that was really boosted during the pandemic, but now has been in recession for quite a while?
Yeah, you're right, Lisa. The manufacturing sector has been suffering for almost 2 years. In the first year, last year, most of it was due to the pullback of consumers away from spending on goods. That's pandemic-driven. But this year, I think the story is different. Right now, we're seeing potentially recessions in Europe and in Canada, and China is slowing. So all of these manufacturing powerhouses like Germany and China in the world are slowing. So there seems to be a second leg to this downturn for manufacturers. And this one is truly a reflection of demand destruction caused by central bank rate hikes rather than a pandemic adjustment.
I look at this, Anna, and just very quickly here as we get to this report. Are we a fully employed America?
We are certainly very fully employed, Tom Keene.
Anna, thank you so much. Anna Wong there.
Are we wrapping things up
I think we're wrapping things up
right.
there. Yeah.
Anna Wong, Bloomberg Economics.
I can't say enough about the magnitude of her call.
Keep it together, Brammo.
Come on,
out of respect for payrolls, I've put a suit jacket.
Oh, yeah.
On.
Good.
That's good.
I've been
nice.
I did not.
You're very tonsorial.
Smart enough.
Very good. Yeah. Great.
Yeah, he's
too slim fit.
He's back.
Got to take the stuff out of pockets.
He's going to get.
Put on some weight when I was away.
Next.
It's one thing to make a call, but to be as lonely as Anna Wong was with Bill Dudley, Mohammed El-Arian, and others, I can't convey how alone they were when they said, "Forget it, rates are moving up."
And now she's one of the ones saying that we don't see the labor market weakness that's going to happen, and the fact that the nonlinear jump up in unemployment, which typically happens during a recession, is still in the wings. And to me, that's sort of the unknown hovering over markets. Is that good news at that point?
Exactly. Fed is done. Good news by stocks.
Right. Well, this is exactly it.
It matters why the Fed might be done. And it matters what happens with the economic data. And I know you don't want to talk about the soft points in the Apple earnings report, but
they were there.
Weakness in China.
Well, the China thing's a big deal.
The Maersk news out of Europe today on shipping. It's pretty pronounced.
Even the raging bulls of Apple, Dan Ives, over at Loop Ventures as well, they're talking about China as a real challenge. David Rosenberg in Toronto publishing moments ago, and he says productivity, John, for these markets, not for the Fed, not for the eco-babble we're talking about, but David Rosenberg says productivity is a thing of beauty for the markets that we saw yesterday, and that's added to the surge that we
And you want to see a whole lot more of that. We'll catch up with Nadia Lovell of UBS on the equity market in about 5 minutes from now. Then it is the countdown to the payrolls report, 35 minutes away. And these are the numbers we're looking for. 180K, 180,000 is the median estimate in our survey. Unemployment, looking for that to come in at 3.8%, in line with the previous month's read. The job data just around the corner. Equities coming back about 0.1% on the S&P 500. Yields lower on a 10-year by a couple of basis points. Your yield this morning, 463.67. From New York City, this is Bloomberg.
We're sort of not out of the woods yet.
It really feels like right now we're in a transition period.
For a lot of people, the soft landing narrative is still in place.
As long as we get the economy right, I don't think we're going to have a recession next year.
Everybody wants to know who's going to ring the bell when it says, is it soft landing or is it a recession?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Jonathan Ferro and Lisa Abramowicz, they're in today. It's Jobs Day in America. Decided to show up. Nadia Lovell to join us here in a moment. And it's a Jobs Day. And I'm sorry, there's many, many mysteries out there. And John, I mean, do we go up another, 200 Dow points here off of the jobs report?
Oh, you were trying to wind me up, aren't you?
Yeah.
Let's start with payrolls. The estimate for the number that drops in about 30 minutes' time, 180,000. The previous number, a blowout 336. So far, so good for the bond market bulls. And, by the way, for the equity market bulls as well this week. We've had everything we wanted, haven't we? Treasury refunding wasn't too bad, right? Look at the data.
Good, and I missed
the ISM came in soft. Chairman Powell didn't disrupt things. Will you get a clean sweep when you get payrolls in 30 minutes' time?
I think you also get a little bit of revenue number here. I mean, the earnings are coming in. There's different opinions I'm seeing on down the income statement, what's going on. But as a general statement, nominal GDP third quarter was a blowout statistic, and that sort of helped corporations amend and adapt here. You missed it, but Ellen Zentner last week, her decline in real GDP, John, in the fourth quarter gets you to a jobs report of 50,000. We're not there yet.
That's an easy call,
We're not
though.
going to see that.
It's an easy call to sit here and say the third quarter as good as it gets. From here,
yeah, thank you.
Slower.
You do okay?
It's how much slower from here. It's whether the global economy is going to be held up by who? By Europe right now? I don't think so.
Yeah.
By China? Real struggle. Look at the Apple numbers that we had out. iPhone sales in China, real difficulty over there.
So
Moller-Maersk, AP Moller-Maersk, the latest numbers out of the shipping company over in Europe, Tom.
So, Lisa, what's that fold over to in terms of not maybe even this jobs report, but the jobs report before the December Fed meeting?
I think if you put this together, there's a question of what does Goldilocks look like? And, John, you've been on top of this. But this idea of when is it not good news anymore? When do we have a sense of a non-linear increase in unemployment at a time when you do see this kind of headline with Maersk cutting at least 10,000 jobs globally, when you do see the potential for further cuts within manufacturing, when you do see people working longer work weeks in a sign that they need to finance the grocery bill that's gone up dramatically over the past 2 years?
Let's review that because, John, this is important. And this was a headline that we saw talking about cumulative monetary policy and Lau Brainerd and all that. Lisa and I did a study of cumulative grocery inflation. Up 3.5, then up 3.5, then up 11. And I did a compound, took the HP12C out. Groceries are up 19%, according to USDA, over the last 3 years. That's part of this jobs report today.
We can sit here at 8:30 and tell everyone how things look good. Unemployment's got a 3 handle. Let's see if it still does in about 27 minutes. Tom, we can sit here and say all of those things.
Right.
So many people in this country don't feel it. You go and look at the consumer confidence surveys. It doesn't show up in the way that this administration, this White House would like it to. Whether that changes between now and next November is a very important question for the president.
And it goes again to what we're going to hear from the Department of Labor later today. They're going to have to spin whatever statistic we see. And after the boom, the shock number that we saw, and again, you got to adjust here, folks. Lisa, you got to adjust by 48,000, according to Michael McKee on UAW.
Because of the strikes. And this is, again, the vagaries, the uncertainties of just how fungible some of these numbers are. The fact that these strikes happened, it seems like people are coalescing around the idea this was the last gasp ahead of the last opportunity to really rally behind this.
The real yield down 2 basis points, 2.25%, John. I'm sorry, yields smashed lower even in the inflation-adjusted world.
Down 20 basis points on a week. It's been a big move in the Treasury market, big move in the equity market too. The stock market poised for its biggest weekly gain of the year so far. On the S&P 500, we're negative by 0.1% on futures this morning. In the equity market through Thursday, the S&P up by something like 4.9%. The NASDAQ 100 TK this week up by more than 5% Monday through Thursday. We've been higher every single day this week in the equity market.
Nadia Lovell nailed that. She's senior U.S. equity strategist, UBS Global Wealth Management, and joins us this morning on equities. Nadia, what I've seen, and this is off the October low, and then there's been this churn, breakout, no, breakout, no, breakout, no. Can you signal the way we've gone up this week to be the form of up where you do get an equity surge to a new level?
Yes, Tom, as we've been saying, we thought that this dip is viable, and we still think that there's more upside to the market from here. And so we expect the market to continue to rally into year end. You do still think that, sentiment is still too bearish. When you look at the AI bear indicators at the highest level it has been for this year, you also have position in that's still light. And as you noted earlier, the earnings season is coming in better than expected. And so we think that the outlook continues to improve. You also have seasonality. We know that historically when you've had a strong January to October, that acts like a tailwind to the market as well.
How much in this does the 2-year yield have to come in as a cash proxy? I'm folding it into Fed speak. But how much do we have to go from a 5% level on, say, a 2-year to a lower yield to really signal where equities compete with cash?
I think you have to see the 2-year come in, probably down to like a 4 handle. For it to make it seem like equities is more attractive. But remember, we don't think that the higher bond yields, and particularly in the low end of the curve, we know isn't sustainable, because once the Fed starts to cut, those will start to come down. And so longer term, you do want to move out in duration, and also longer term, you do want to maintain that exposure to equities, because you don't want to stay on the short end for too long, given the fact that the Fed is likely done hiking and we'd be in a position to cut next year.
We're in a sort of awkward position today, Nadia, where a lower than expected job creation number will lead to a rally, most likely in stocks, as long as it's not too low. What is that too low point where bad news is bad news for risk assets?
I think if you get a job numbers that's under 100,000, that will probably signal that the economy is slowing much faster than anyone had expected. I mean, coming off of the momentum of the third quarter, we are looking for a slower growth, but we're not looking for a recession. We're looking for GDP to sort of slow down to the 1.5% range over the next couple of quarters. But if you have a job market that rolls over too quickly, then there's concerns about consumer spending, and it probably puts the Fed in a tough position and probably has to start cutting sooner than expected to.
You said something, Nadia, when building on that point of the Fed having to cut sooner than expected. How much is your bullish view and those of others who are in the equity markets predicated on this idea that the bar to cut, as John was talking about earlier, the bar to cut rates is actually lower than it used to be, based on what we heard from Jay Powell this week?
I don't necessarily think that the bar is lower than it used to be. We've always maintained the view that if the job market starts to roll over, that the Fed is going to be quick to respond to that. The Fed continues to try to thread this needle to avoid a recession. And so we do expect that now that the Fed has said that the risk is balanced, that they will be quick to respond to any sort of weakness in the job market. But I think the job market will have to get close to turn into negative payrolls before the Fed respond. That's always sort of been our view. So we don't think that that's changed.
Right. Nadia, how do you measure growthiness right now? Everybody's looking at Apple. John Ferro will have Tom Forte with him at 9:45 here, who's really cautious on the growthiness of Apple. But how do you, as a broad strategy, measure how a company's growing?
For us, top line is important, and then maintaining margins and having margins that are expanded to help drive that sort of bottom line growth is important as well. I mean, I would say in terms of, it's not too surprising to see, like, the leader in smartphones see some softness, particularly overseas, just given the headwinds that they've also been facing from a regulatory standpoint. But when we look at the broader tech complex, we do think that the outlook has improved, even though we do remain, neutral on the sector. We do think that there are pockets of opportunities. And when you look at throughout the earnings season, I would say, Tom, with new tech, it's actually been pretty encouraging. You're seeing some stabilization in IT spending. You're seeing a pickup in AI-related revenues. And even within semis, I think that you're starting to see some of those areas bottom out, particularly in PCs as well as servers. You are seeing the analog areas sort of roll over, so we're a bit more cautious on that. And so we do think that the growth complex still remains intact, even though you might have some outliers in some of the larger names, like particularly in the smartphone and hardware area.
We've seen this incredible rally in big tech so far this year, and big tech was one industries that publicly announced a whole host of job cuts last year. Going forward, in other industries, do you think that announcements of job cuts will be good news or bad news in terms of a signal to go buy them?
I think in terms of additional cuts in the broader economy, we know that tech and some parts of finance had excesses coming out of the pandemic. And so I do think that the market will become cautious if you see more wider range cuts in other sectors, because it would signal that the economy might be slowing down. So not necessarily would jump in, 2 feet into these areas if you start to see weakness in terms of cuts. But at the end of the day, if companies start to cut aggressively, it's probably an indication that top line is softening and they're cutting headcounts to be able to, preserve margins. And so I don't necessarily think that that is a positive indication. Because it's unlikely to be excesses, and it more has to be do with top line, protecting the top line.
Is that the next phase? Nadia, thank you. As always, Nadia Lovell there of UBS Global Wealth Management. Nadia's views and UBS's views on the equity market going into the opening bell, about an hour and 20 minutes away. Before we get there, we need to deal with the payrolls report, Tom. 180,000 is the estimate in our survey.
It's going to be fascinating. I don't have any. So people email me. They go, "Do you want to be in our pool about guessing what the number's going to be?"
And you say,
it's even normal.
Do that anymore? Jobs guesses? I don't see jobs guesses anymore.
No, it's basically a dartboard.
It's a dartboard. That's right. Maybe that's giving it too much credit that it's a dartboard. I just don't play the game. What I know, John, for certain, is I went down in flames on the analysis here of Man U Newcastle. This was an uproar.
Did you have money on Man U?
No, yeah, I did. Okay. But Bramo, she nailed it. You should have heard the two of us doing John Farrell's soccer talk.
Did Bramo watch the game?
It was thousands turn the channel.
I don't want to talk about that.
Thousands.
You know what? I despise the fact that you make this about me. That you call it John Ferro Soccer Talk, because you're responsible for this, not me. You are responsible for this.
Big game this weekend, Newcastle, Arsenal. Okay. And it's not a derby, they're far apart, right?
Geographically, yeah.
I nailed that, folks. Thank you. But this is pretty cool. I mean, these are two really invigorated teams.
I'm excited for the F1
below
this
the
weekend.
tots, but
Sao Paulo, Brazilian Grand Prix this weekend.
How is that?
Very cool.
But you watched soccer down there,
I did 2 weeks ago, yeah.
Yeah, very
I watched the local
cool.
derby, Palmeiras, Sao Paulo.
Why is Brazil F1 a big deal? Is it on a big ugly track like Austin, or is it like
It's
Rhodes?
one of those old school tracks, very cool, lots of history.
Old school track.
Yeah. It's going to be great. Look out for that, Tom, this Sunday.
Okay.
That's your sports wrap.
If
you're just joining us, we're back on track, apparently. Welcome to the programme. We're negative by 0.01%. Payrolls just around the corner. Tom, to watch the game in Brazil was fantastic, Brilliant. Young lad there, playing for Palmeiras, Endrick, teenager, I think turns 18 next year. He's already been purchased by Real Madrid. So he's going to complete the season there, and once he turns 18, he's going to go over to Madrid. Okay, fantastic football player.
Is it Rick Carlson for the Tots?
For the Tots, yeah.
Why is he struggling? He was giant in Brazil.
No,
right?
he's just not as good.
He's not as good.
Okay. Do you know what was interesting about going to the game?
See how he gets going, Lisa?
Facial recognition. Recognition to get into the game, yeah.
Well, that makes sense to prevent violence.
You turn up, no away fans, No away fans. You turn up to the game.
Interesting.
Scan your face. Walk in.
There's a reason for this.
John, for the 2000
violence.
John, for the 2000. John doesn't know this, folks, but for the 2024 surveillance budget, we're going to have facial recognition.
Are we?
For our guests
to get into the studio.
To get into the studio.
Can I just say, I'm getting trolled by some of my emails. One of them, Arsenal is the most expensive Premier League club for football supporters. Chelsea, Tottenham, and Liverpool are among the others.
Bramowicz in.
More
Is
expensive.
that one of those PR emails?
Yeah, but like people are targeting me now with them.
I love
Thanks
that you
to
open
guys.
that stuff up.
I do.
What we want to see is a little bit more slowing in the labor market in order to see more slowing in those components of inflation. Because if we look at the ECI, it does look like wage gains are still a little too brisk to be consistent with sustainable 2% inflation.
We will get another read on inflation, on wage growth in about 15 minutes' time. That was Jonathan Pingle, the chief US economist over at UBS, going into the payrolls report. That payrolls report just around the corner. Here are the scores in the financial markets. The price action looks like this. On the S&P 500, we're negative 0.07% on the S&P. Yields are lower by 2 or 3 basis points on a 10-year, 463.25. Backing away from those cycle highs of a couple of weeks ago. 3.5% for a heartbeat on a 10-year, then all the way back down again, Tom. Lower by almost 40 basis points now in the last couple of weeks. We're down 20 this week alone.
A changed world in the last week, and again, we're watching equity markets, and I'm going to call it there's a constructive bid to the tape after the festivities we've seen over the last number of days. If you come out of the University of North Dakota, you're an engineer, and somebody says, hey, do you want to write a microeconomics textbook with Austin Goolsbee and Freakonomics Steve Levitt? You say, yes, sir, I'd like to do that. Randall Krosner knows who I'm talking about. It's Chad Syverson, who's expert on productivity in America. Syverson is at the Chicago Booth School. And joining us now, the former governor of the Federal Reserve System, Randall Krosner. Randy, you go in and you have a cup of coffee with Chad Syverson this morning on this mystery called productivity. Has it really changed? Do we grossly underestimate on this jobs day the productivity of America?
It's one of the key things is trying to get the measurements right. And when you're in an unusual situation like we've been in over the last few years, there's a lot of questions about whether we're measuring the number of hours correctly, because of course so many people are working at home. And as we move more and more into services, it becomes harder and harder to measure productivity. It was easy when you're just like churning out particular pieces of machinery. You can see it takes 4 people to churn out 2 machines a day. But when you're providing services, it's a little bit more difficult to get those measures right. But I think we are in a pretty good position with respect to productivity these days.
I mean, the chart that I had earlier, Randy Krosner, we don't need to show the chart now for radio. It's too much stress. But the idea, Randy Krosner, of age 25 to 54, that COVID rebound is spectacular. Was that all because of stimulus?
I don't think it was just because of stimulus. I think some of it was coming back naturally because, of course, you had lower labor force participation after COVID. People were pretty worried about their health situation of going back into work. But now we have more flexible situations, still a lot of people working from home. That's allowed more people to come back into the market, job market comfortably. And so basically, we're fully back in terms of labor force participation, except for older workers. And that makes sense because they're the ones who are probably the most wary of coming back into the office. And even if they don't have to come back into the office, they said, you know, we've seen too many people not make it through. I want to spend time with my kids, grandkids, and so I'm not coming back in.
We are seeing, though, the work week starting to lengthen a little bit. People are working longer in order to make ends meet, especially given grocery bills and everything else going up as much as they have. And this morning we saw Maersk put out an announcement, the shipping company, saying that they plan to cut at least 10,000 jobs in response to declines in demand across the world. How much is this a sort of foretell for what's going to happen in the next couple of months, particularly with manufacturing jobs?
Yeah, as you know, as I think I've mentioned here before, my view is, people have talked about a hard landing, soft landing. Jay Powell talked about a softish landing. I'm talking about a hardish landing. I really don't see how the economy can continue on in this way with astonishingly strong job growth and really get inflation sustainably down to 2%. I do think that it's likely that we're going to see some softening in the labor market over time, maybe not this month, but certainly over time. And I think that's one of the key ways in which you'll get less wage pressure, less overall price pressure, and getting back to the 2% target.
What surveys are you looking at? I know that holiday hiring isn't necessarily as big as some people were expecting, according to some initial views. What tea leaves are you tracking to understand that, yes, a hardish type landing is the most likely scenario with some sort of jobless rate increasing at a nonlinear fashion?
Yeah. Let's not go too far make sure we have a distinction between hard and hardish, because I don't think we're going to be going off the cliff. But I do think it's likely that we'll get the unemployment rate above 4% relatively soon, and probably to the mid fours. And so I think you can see there are somewhat fewer job openings. You can see more and more concerns about that firms are discussing. You also see that workers feel a little bit less confident. You're seeing a lot less quitting than you had from before. That's getting back to sort of a more normal labor market situation. And in a more normal labor market situation, we're probably going to see a bit of an increase in unemployment before we get wage growth to really come down to what will be a sustainable level consistent with a 2% inflation target.
It seems like Fed Chair Powell is on the same page with you, equally concerned about greater weakness than expected in addition to the inflation backdrop. Do you think that the Fed will be more willing to cut rates more aggressively next year if what you expect to happen comes to pass?
So I think they're going to hang tough, and hang tougher than most people expect, because over the last 20 years or so, the Fed has always been there to provide a cushion against a downturn. Now they know that they may need to take that risk of a softening labor market and even potentially a mild recession in order to get to their inflation goal. And they've made it clear that the 2% inflation target is what they're sticking to. That is their goal. And if it means that the unemployment rate may rise a little bit more than they expect, I think they're going to hang tough on that.
Professor Krasner, I'm going to treat you like a market economist. Where's the tip point on the unemployment rate in your head for when you say we're moving beyond full employment or the glory that we're in right now? Is it 3.9 to 4? Is it 4.5, or is it a statistic higher?
So I'd say in the environment that we're in, it's sort of low fours. It's really been quite astonishing to see the unemployment rate below 4% for so long, particularly as labor force participation has come back. So I think it's likely that we'll move a little bit above that to the upper fours, or maybe even into the fives. Now, of course, that's not the best for the labor market, but boy, compared to past slowdowns, that's still pretty darn good.
I looked at Topeka, Kansas. I think it's 2.9% as a statistic right now. And there's a nice, pretty chart from, I think it's St. Louis Fed, which shows it used to be 3.5%, 4%. Do we have to almost R-starred set our unemployment rate lower over what is normal?
Well, that's one of the things that's being debated now, along with the neutral rate, the so-called R-star. Has that fundamentally changed? Most people think that during the slowdown times that we've had over the last pre-pandemic, and into the beginning of the pandemic, that neutral rate was much lower. A lot of discussion about the unemployment rate. Now people think the neutral rate is higher. And then the question is, what is the benchmark rate for the unemployment rate? I don't think it has moved down as much as people think that it might have to the threes, but it's one where it's really difficult to estimate in real time. And it used to be something that was seen as fairly constant, and now it's something that moves around a fair amount in our estimates, just like that neutral rate.
Hey, Randy, stay close. We need to catch up with you again in just a moment. If you are just joining us 5 minutes away from the payrolls report in America, Mike McKee joined us now to give you a little bit of a preview. Mike McKee, I'll do the basic stuff. The estimate, 180,000. I know you're focused on way more than just that.
Yeah, we'll be looking at the unemployment rate because, of course, the Fed has tipped that as one of the key measures they're following to see if the economy is slowing. 3.8%. It had gone up from 3.5, so a significant move a couple of months ago, and then it's locked in at 3.8. Does it go up to their 4.1? That'll be a key question. And, of course, the Fed, everybody else wants to know what's happening with average hourly wages. Right now, we're at a 4.2% annual rate. Does that slip down a little bit more and give them some relief on the wage front? One thing we want to mention, John, and I know I told you guys about it earlier, is the strike situation. 48,000 workers off the job, 30,000 of those or so from the UAW during October. So mentally add in to that 180, and you're looking at about 221 or so, 228. So keep an eye on that as an explanation if the number comes in a little low.
If we do talk about data dependency, and as people were saying earlier this morning, that this still is a data-dependent Fed, if they are we looking at continued acceleration, or are you seeing the signs of that would give you pause, the deceleration signs that we heard from Anna Wong and from Randy Krosner?
You can make a list of all the indicators, Lisa, and you come out about half and half. Some of them are suggesting things are going to go at about the same pace, and others are suggesting a slowdown. Now, you would expect a slowdown. That's what's supposed to be happening. And we used to be worried about whether we would slow too fast. Now we just seem to be worried about whether we slow at all. So going to be interesting to see. Now, as you mentioned, data-dependent Fed, but we have a lot of indicators, another employment report even before the next Fed meeting. So this one won't carry a whole lot of weight other than in the markets.
Michael, what's the geographic and demographic distribution of our fully employed America? I've been mentioning Topeka, Kansas. I picked them out because I watched The Wizard of Oz last week with Afterthought. But, you know, help me here, Michael. How geographically distributed is this, or is it more homogenous than we think?
It's been generally pretty homogenous, which is kind of interesting. We haven't seen a lot of migration, and of course that's a topic for economists like our friend Randy Krosner. What's happened to the idea that Americans pick up and move, the Dust Bowl movement to California kind of thing? People are much more tied to their communities, and we've seen the effects of the offshoring, the move to China, sort of play out now. And now you're in a situation where people aren't moving as much and jobs aren't moving as much. What's interesting is that this new infrastructure spending that the Biden administration is doing, they're awarding contracts to areas where unemployment is relatively high and people have lost jobs, and trying to even things out. We'll see how that works out.
Mike, you know how this gets filtered on Wall Street when the data drops in about 2 minutes' time. You look at the data, you ask a simple question, what does it mean for Chairman Powell? Then you trade accordingly. Mike, how relevant is this information for the Fed chair, for this committee, a little bit later?
It's not particularly relevant. It'll be relevant on Wall Street for the reason you suggest about the question that they're going to ask. But we're going to see rates move around a lot between now and the time the Fed meets again on December 13th. We've got inflation reports, jobs reports, spending reports. So they're not going to pay a whole lot of attention to what's going on Wall Street until they get closer to the time, of course, barring any kind of collapse on Wall Street. But until we get much closer to December, they're going to be sort of on the sidelines watching film, as the football coaches would say.
Mike McKee, stay close. Thank you, buddy, as always. They take note of the tightening of financial conditions, and Bramo, right on cue. The financial conditions are less tight.
Exactly, which is the reason why they said, you know, it has to be a sustained move. You do wonder whether they're getting a little bit concerned about the whipsaw action in the wrong direction, easing financial conditions.
I've been remiss. I didn't mention this. I'm sorry. Maybe in months and months and months, the revisions here, John, are a huge deal. I'm still not used to a 336 number here last month. I'm fascinated how that gets revised.
I really missed you over the last week. Got emotional. You called me a lot as well.
Okay, can you get me the Kleenex,
called
please?
Me a ton.
You know.
You're sounding better. When are you coming back?
Yeah.
Just admit it. That's what you said. That's what you said yesterday. It was emotional. Good.
You know,
if you are just joining us, it's been very
emotional.
emotional.
I'm in therapy with
over
HR.
The last. How's therapy going?
Oh, with HR, it's going great.
It's going awesome. It's going awesome. Payrolls just seconds away. Here are the numbers we're looking for. 180K is the estimate in our median survey. In our survey, that is the median estimate, 180. 336 is the previous number. For unemployment, 3.8%. That is the estimate. The previous number also 3.8%. Going into these numbers, equity slightly negative on the session, but up big time on the week. On the S&P 500, we're negative right now by about 0.1%. Yields are lower by 6 basis points. The job numbers drop. Mike McKee's got them. Hey, Mike.
John, they come in a little bit weaker than anticipated, 150,000 for the month of October in terms of jobs created. Now, remember, you got to add in those 48,000 strikers, so we're looking at basically 198 here. Change in the unemployment rate, we go up to 3.9%. That's a tick closer to where the Fed thinks that they might want to be. Tom was talking about the revisions to prior months. The September number revised down from 336 to 297, so a significant change there as well. Average hourly earnings up 0.2 as forecast, which drops the year-over-year number to 4.1%. So in all of these numbers, we're kind of moving in the way the Fed wants to see it. Net revisions down 101,000 when you add in August as well. Labor force participation rate ticks down a little bit to 62.7. The U6 rate, 7.2%. That's a little bit higher. So we'll see how the markets are kind of reacting here. I might mention loss of 35,000 jobs in manufacturing, and we saw that weak ISM number earlier this week. So maybe that is what is playing out.
Mike McKee, take a guess. It's a clean sweep for the bond market bulls. Yields are lower by 8 basis points at the front end, 2-year, 490. 10-year right now, 457. Yields lower on a 10-year maturity by 8 basis points. On a 30-year, down 5. So bonds rally, yields drop. In the FX market, the euro pops, getting close to 107. Right now, 106.94. That currency pair positive by 0.7%. Put it all together, equities rally. On the S&P 500, futures higher by 0.4%. A clean sweep this week, Tom, for the bond market bulls. They've had everything they wanted, every single data point. The Fed speaks so far from Chairman Powell. Throw in the labor market data as well.
If you're short, if you're out, what do? You got to get in now. And what I'm going to go to, and you heard that, John, with Michael McKee's breadth of data, this wasn't about one data point indicating a softer labor market. It was 1, 2, 3, 4, even 7 of these data series indicating an ebb from that fully employed America.
It's early days, things can change. We're only 2 minutes past the number, but Lisa, it's not too hot, it's not too cold. What might you call it?
Goldilocks.
Oh,
do you really want
that
to do that?
It
did painful. Hurt because honestly, we're looking at actual weakness, particularly in that manufacturing sector. And I want to piggyback on what Anna Wong was talking about and the Maersk numbers. Is this a leading indicator of more cuts to come? It's Goldilocks until it's not. It looks like a soft landing until it's not. And that is definitely where people are going to be focused. Again, I want to see whether, yes, maybe the move in the bond market sticks. But what about in risk assets? Is it still good news when people aren't getting employed as much if it leads to something more significant?
Right. Mike McKee, I know you want a second look at this one. What do you see?
Well, you take a look at the unemployment rate, and we had a big drop in the labor force size of 201,000, which contributes to a reason we see the number go up. But the employment level in the household survey down 348,000. The level change for unemployment up 146. A lot of people like to glom onto the difference between the household and establishment surveys, and this certainly will give those people some ammunition in terms of the number of people who are unemployed or who have lost their jobs. So there will be some talk about that. The other thing that sort of stands out is that in terms of job creation, private service jobs, 110,000, but those are really distributed kind of across the curve. Healthcare workers are pretty much, as always, the leaders here. Leisure and hospitality, 19,000 jobs, so still adding some there. Where you really see some movement, construction up 23,000, and government up 51,000 for the third month in a row. So maybe some of the seasonal factors that have been affecting government spending have kind of petered out. But at this point, what it looks like is a fairly evenly distributed between losses and gains, and no particular area that is that stands out. Although I do need to check, and I'll go do this right now, on auto workers.
Well, we've got the data here, Mike, and I guess the question is this a 1 month, first month move, or can you take, say, 3 months annualized of any of these numbers and say we have a vector in place to a weaker jobs market?
I don't think you can. Because manufacturing, for example, we lost 35,000 jobs, but we gained 14,000 the month before. It doesn't look like there's any one category that screams we're turning around here, that things are getting much worse. We have a number that you could keep an eye on. Manufacturing, retail only adding 1,000 jobs, those kind of things. But you're going to need a couple more months of this to discern any particular trend.
Mike, thank you, buddy. Looking forward to talking with you again in about 25 minutes' time. It's not terrible. It's not amazing. It's something in between, and the bond market likes it. Treasuries rallying here. 10-year yields down by 9 basis points, 4.57 on a 10-year. On a 2-year, down 8 basis points, 4.90. Look out for Mike McKee with the Atlanta Fed president, Mr. Bostic, a little bit later on. Raphael Bostic, the Atlanta Fed president, 3:30 Eastern time. The way we always think about this, here's the data. Tell me what the Fed thinks about it. You'll find out a little bit later on this afternoon with Mike McKee. Tons of Fed speak still to come. On the open, fantastic lineup. Rick Reeder, Mike Collins, Anastasia Amoroso, Mohammed Al-Arian. All of that still to come next hour on Bloomberg TV. Tom, with a downside surprise on a payrolls report, 150, and an equity market that's at session highs, positive by 0.4%.
And puts it on here. It'll be fascinating to see how we get to your conversation with Dr. Al-Arian. Futures up 18, Dow futures up 136, and the VIX, sprightly. I can't fathom a 14 VIX. We're not there yet, but 15.35. Lisa, the bond market is extraordinary. From the peak there of just above 5% in the 10-year yield, good Bloomberg mathematics, it's a 4 standard deviation move from +2 SD down to -2. It is a complete gap move down now in the 10-year yield.
And not to be wonky, you're watching the 10-year yields, and it has been a gap move. I'm actually watching the 2-year more closely today, because the move is pretty substantial from session highs to session lows of about 10 basis points, and this feeds into the Fed's reaction function. People are viewing this as keeping the Fed on hold and possibly implying more cuts than they currently are signaling.
What you need on Jobs Day, more Newtonian calculus. We'll do that with Randall Krosner of the Booth School of Chicago, of course, the former Fed governor, one of our great and giant financial economists in America. What's a second derivative of the jobs market look like, Randy? When it moves, does it move?
And that's the key question, exactly what you were talking about. What does this portend for the trajectory going forward? Certainly, we're seeing a slowing pace over the last few months, downward revisions. And then the question is, will this be nice and smooth, or will this portend something that is going to be, as Lisa mentioned before, nonlinear? Very difficult to predict any nonlinear moves and things, but I do think it's consistent with a somewhat softening labor market. I think the Fed will certainly be heartened by the wage growth coming down a bit over time. I think this takes the wind out of the sails of those who wanted to go further. I think it makes it much more likely that we will just hold where we are for a while. But so far, there's nothing in this to suggest that the Fed is going to be eager to cut or be even talking about cutting anytime soon.
Do you think, Randy, as some people are pointing to manufacturing as a point of weakness, that is a leading indicator in the way it has been in previous times, just because of how many people were hired during the peak of the pandemic?
It is certainly one area that there was a lot of bounce back because, of course, people wanted things, but now people want services, and so the services part is still extremely important. I wouldn't put too much emphasis on any one particular sector. I think you have to look overall. And as Mike had said, we're seeing a little bit of slowdown broadly, but not enormous amount of slowdown. But I do think this is consistent with, in some sense, where the Fed wants to go. They want to see the unemployment rate go up a little bit, not too much. They want to see wage growth come down a little bit, but not too much. And I think it's just going to be tougher to be hiring people going forward. Until just a few months ago, real wages were not growing. They were actually negative. Real wage growth was negative. Now real wage growth is positive. So that gives less of an incentive for firms to hire. Real interest rates are now positive. They had been negative for a very long time. that combination is probably going to lead firms to be less eager to hire, less eager to invest. And I think that's going to be leading to what I think is potentially a hardish, but not hard, landing.
This is an important jobs report. This November report of the October data, just absolutely extraordinary. Randy Krosner, thank you so much. Professor Krosner with the Booth School, the University of Chicago. Futures up 17, Dow futures up 139. I'm going to call it a 0.4% move. Lisa, what do you see over there? Your screen's cleaner than mine.
I'm looking at the 5-year yield as well, because that's one way to look out over rate cuts. And it's coming down quite a bit, but it's 4.5%. Also, getting some color from some of viewers, so I want to thank them for this, saying that the tone has changed materially for companies looking to sell debt, that suddenly they're ready to go back to market and to lock in some costs, because just some stability and yields coming in a sense that buyers are still going to be there is enough to bring people in. There is still a tone underneath all of this, a very strong risk appetite, and a sense that really we are going to get a soft landing, and this highlights that.
My number one advisor, Marty Schenker, holding court in a cafe in Paris right now. And I said to him last night by email, I said, when does Apple do a bond offering? I just wrote it out with this market move, and now this even more on steroids.
And we're still looking at higher borrowing costs than we had in the past, but the strength of the consumer and the strength of the balance sheets, to your point, is giving people confidence even at some of these levels.
As Lisa speaks, we have the 10-year real yield with new effort lower. We've gone from 2.20 to 2.19. If you're not part of the global Wall Street gang, you've got to understand it's hard to look at the Bloomberg screen and frame it out from where we were 2 weeks ago, which gets us to Keynes. And when the facts change, I change. Jeffrey Rosenberg studied as Maynard Keynes at Carnegie Mellon. He's a BlackRock portfolio manager, systematic multi-strategy fund. For all of us, Jeff Rosenberg, are the facts changing?
Great question, Tom. The narrative is changing, and the facts are driving that. And so Lisa asked the key question, how do you rally in front of a slowing labor picture? And that's because it's where we are. Equity markets were weaker while the economy was strengthening. And that was really about the rise in the denominator, in the discount rate and the interest rates. So as you ease off the pressure in terms of the interest rates, there's a little window here where the narrative changes and there's relief because the discount rate is expected to be a bit lower, and you see it in the bond market. But that's about horizon. And so the near-term horizon narrative will shift, but the longer-term horizon about that hardish landing that Randy just mentioned, that'll be, for future conversations. Right now, the market's pretty excited about lower discount rates.
Jeff Rosenberg, people would say BlackRock is part of that wall of money that's out there. Okay, we got a short cover here, a short cover there. I got futures up 18. Rosenberg knows the numbers better than me. Are we underestimating, Jeff Rosenberg, how many people here are off sides and need to get in and play now?
Yeah, we talked about this after the FOMC. The near-term volatility is all about technicals and positioning, and so you're going to have that, and you're going to see those moves. The longer-term positioning is going to be about trajectory and fundamentals. But certainly, after a report that pretty much convincingly across the board, as you highlighted earlier, this is a report that helps to support the narrative of slowing in the labor markets, slowing in wage inflation, even though that's a mixed shift probably in the AHE number. But across the board, especially with the revisions, it just looks like this is coming in slower. And so that helps to feed the near-term narrative that you get to the soft landing. As Randy said, whether it's soft landing or hardish landing or hard landing will remain to be seen.
When do you go with groupthink and when do you push back, right? I mean, when do you go with the crowd if sentiment is shifting and you're seeing people go into risk, if you believe that essentially bad news will be bad news for risk assets?
Yeah, it's a lot about kind of looking at what's in the price and how much cushion you have against the consensus move and where the asymmetries lie. So I think right now the momentum and the sentiment around soft landing is going to be pretty hard to push back against. But, as we see successive waves of data, we got a couple more here in terms of before we get to the December FOMC, there's going to be a little bit of momentum here around the easing off of financial conditions, the easing off of tightening from the Fed. And I think that's going to provide a little bit of a tailwind for a short horizon trade.
And definitely the momentum tends to overshoot. And there is this feeling that this does set the market up for more fragility heading into a print that could be a big surprise on the downside. Jeff, how much is that sort of the play right now? Is to lean into the momentum, go with the flow, soft landing. Sure, you can celebrate, but the music will stop eventually. And each one of these economic prints are going to have that much more heft and importance in markets.
Yeah, and the main issue here is really about long and variable lags. And Tom, I know you hate every time I say that, but it is, where do you see that pressure coming in? Randy talked about the pressure in terms of easing off of hiring because real wages are no longer negative; it's more expensive. You talked about funding costs, and maybe there's a little bit of an opening up in terms of the bond market, but I don't think I think you got to remember here. These are much more expensive funding costs. And so
right.
If you don't have to issue that debt because you've termed it out, you don't want to issue that debt. And so even though the market may be open, it's at a much higher cost. And that lagged effect of tightening in terms of interest expense is something, the market is still going to have to figure out where are the vulnerabilities. And there are vulnerabilities to that impact.
On Bloomberg Television and Radio, Jeffrey Rosenberg with us with BlackRock, really timely. And, of course, we thank him for his Fed work as well. He's going to stay with us right now. I can't do a complete data check because Jeff Rosenberg is too important. But, Lisa, there's some real nuances here. Futures up 19, continue to advance. Dow futures up 139. Can I get to a VIX of 14? I'm not there yet, 15.26. As Bramwell mentioned, folks, a 2-year yield in 13 basis points. We continue to see lower yields and higher prices. 10-year in a stunning 11 basis points. And just, outside the box here, I got weaker dollar. I got euros through 107. I've got yen dynamics, but euro yen. What does the Japanese institutions do this weekend off what Jeff Rosenberg says? Because I got euro yen 160.01. If they're not going to act now, Lisa, when are they going to act?
That does raise a good question. And, Jeff, to that point, does the move that we're seeing in the U.S., a sigh of relief, open up possible monetary disruption elsewhere? Hint, hint, Bank of Japan, that could be disruptive on the other side.
Yeah, I mean, that's a big global story and one we've been talking about for a while, waiting for. We got a little bit of it in terms of changing the definition of yield curve control. And there's an expectation that there's going to be more. And there's an incredible amount of fiscal stimulus coming out of Japan that is really going to push the BOJ even further. And so that's been a global impact. It's dampening term premium. It's part of the term premium steepening story. The refunding, certainly has pushed back on that and positioning, a bit offsides for that somewhat surprise refunding. But really the big story there is going to be global term premium steepening. And that's, I think, long-term going to come back to the U.S. But near-term, this is going to be about softish landing and slowing of the Fed, and the market's going to run with that.
We're looking right now at 2-year yields just tanking. I mean, honestly, this is quite a move. 15 basis points nearly from top to bottom in this trading session as people parse through this. Jeff, just want to finish up with the Fed's reaction function, this concept of what it takes for the Federal Reserve to cut rates. Right now, there is baked into the markets in real time a sense that they will be cutting rates in much sooner than they're saying. Do you think that's accurate, that the bar to cut rates has somehow come in as a result of just the general feeling in the public and the lack of willingness to tolerate much higher unemployment rates?
Well, it's tricky, Lisa. I mean, I think the reaction you're getting right now, pricing out the kind of probabilities, the limited probabilities of the last hike, right? So, you go back to Wednesday and, you remember the question and, you talked about we're not even, talking about cutting rate. Now, obviously, the market is because the market is looking forward here. I think you got to see a lot more development on the inflation side before you get there. And then the other problem we're going to talk about, I think, is the reflexivity. I think you mentioned it, is that, the Fed could do less because the market's doing more, but the more the market does more in terms of easing financial conditions, the more then the Fed has to do. So you kind of get yourself chasing your own tail around that story in terms of whether they can cut. So it'll come back to, does the inflation really fall fast enough to that 2% level that gets real interest rates high enough that gets them concerned that they're too tight where they really need to deliver those cuts? And that, I think, is still way out into the future.
I mean, Lisa, where do you get a show where Jeff Rosenberg channels George Soros on reflexivity? I mean, there's nowhere else in the world you can have this much fun. Jeffrey Rosenberg, thank you so much for joining us this morning. To get you to the weekend on the jobs report, and again, a great 9 o'clock hour coming up on television and radio is well. On the 30-year bond, as we show it on TV right now, these are ginormous moves as well. Lisa, before we get to Ira Jersey, give me your one fixed income data point you see right now.
I just keep watching the 2-year yield. It's not complicated. And I keep thinking about Stan Druckenmiller and how he came out and said that he was going heavily in a leveraged way, a massive leveraged bet on 2-year yields. And he was talking about that a couple of days ago. Right. How many others had massive leveraged bets on the 2-year yield that are coming to the fore today?
You set up perfectly where I wanted to go with Ira Jersey. Folks, this is how twisted Ira Jersey is in his memorization of Frank Fabozzi's tones. Ira has named his kids after the Greek letters, Alpha, Beta, and of course the third Jersey is named Gamma, Gamma Jersey. Ira Jersey, I'm sorry, Gamma's in play here right now. The other word we would use is convexity. Bramo nails it with the leverage bet that's out there. What's the character of the short cover, if you will, in the fixed income space?
Well, if you're going to have a levered long, like Tom, like you said that Mr. Druckenmiller seems to have put on, you have to have a lot of conviction because the carry in that trade is negative. So if you buy a 2-year note or you receive in 2-year swap rates, the short-term rate, the overnight rate, is much higher than the yield on that treasury or in that swap. So you had to have high conviction.
Right.
You know, it's working out really well now. The question is, how much further can this go if the Fed is going to be on hold for a very long period of time? And I agree with what Jeffrey said. I think the market reaction in the front end right now is firstly taking out the possibility of hikes, and then secondly pricing in for a little bit deeper cuts further out.
Ira, Lisa, this weekend, open housing across the Upper East Side, looking for something with 2 wood-burning fireplaces. When you see this yield move, can you say we reached highs in the 30-year mortgage?
Yeah, it's very possible. I suspect at some point, especially if we have a no landing scenario, price back in because, we wind up getting good numbers on retail sales or something like that, you could wind up back at that 8% mortgage rate. But more or less, we're probably at or near the highs in yields basically across the board, whether that's corporates or treasuries, obviously with the decent rally off of 5% in the 10-year, that's going to help drive mortgage rates lower as we continue to rally. We still think over the course of the next 15 months or so, we're going to see significantly lower 10-year treasury yields. So therefore, you should have also lower mortgage rates.
I'm looking right now at the 5-year yield as well. And that's, to me, some indication of how many cuts are being baked into the system by the Federal Reserve over the next longer term 5 years. It's gone down quite a bit, but it still is at about 4.5%. Ira, are we looking at a scenario of higher for longer that suddenly people are saying, well, it's a good thing because even if it is going to be higher borrowing costs, at least they're stable. We know where they are. At least the Fed is done.
Well, I think that's part of it, Lisa. And a big part of, I think, what's going on with the vernacular is the sticker shock. When we go back to the 1990s or even the early 2000s, 4.5% 5-year yield was fine, right? That's just where we were supposed to be. In fact, you go back to the 90s, that was the lower end of the range for most of the curve. So I think eventually we'll get used to these type of yields where 3.5%, 4.5% is like the norm. We just got used to over the last 15 years interest rates being exceptionally low, and that wasn't a state that was going to persist forever. And I think once once we get used to this, look, a year from now, we're going to say, oh, 5%, maybe a high yield. But at the same time, 4% maybe is just normal.
Ira, thank you so much for your work. Ira Jersey, he will publish today for Bloomberg Intelligence on fixed income. Equities advance up 23 on SPX. NASDAQ really doesn't participate as much, up only 0.4%, maybe exhausted from the last couple days. They got a VIX 15.25. And on the equity space, I really need to listen to this because I'm not in the market. Gina Martin-Adams joins us, Chief U.S. Equity Strategist. Come on, Gina, I got the buy ticket out for the triple leverage all cash fund. Is this a sea change moment coming out of this pandemic, or is it another day at the optimistic payroll races?
Yeah, I think we had our sea change moment in October of 2022 when we had a massive washout in sentiment and overly sort of bearish conditions emerged. This is sort of a mediocre moment, but nonetheless, it's a moment. Certainly earlier this week, we did have another sentiment washout occur in U.S. equities. It wasn't as deep as the October washout, but certainly we were prepared for interest rates to remain very high for a very long period of time. Our work suggested that as of earlier this week, the equity market was priced for a 2-year yield to stay at 5% throughout the entirety of the next 12 months, keeping us on hold in terms of valuation expansion. This does at least unlock some of that constraint on the U.S. equity market, because if we are in an environment where yields can rally, where inflation pressures potentially do continue to decelerate, we might flirt with recession, but the equity market's been talking about flirting with recession for 2 years now. So really this is about unlocking that inflation constraint, unlocking that Fed constraint, and that does allow for some upside lift in equity market multiples.
How much are you concerned about softness that gets a little too soft, right? This idea that this patch of weakness, or at least not as strong growth, it's hard to call this overly weak, a slowdown doesn't become something pernicious for risk assets?
Yeah, I'm not entirely concerned about that, Lisa, mostly because all of the cyclical segments of the U.S. equity market are trading at multiple standard deviations below prior cycle averages. You've got this really interesting dichotomy happening in the U.S. equity market where tech stocks, and specifically the biggest tech and communications stocks in the index, have driven all of the return, or the vast majority of the return so far this year. They're the only stocks trading at premiums. But if you take, for instance, the consumer discretionary space, which is where we've had the most negative guidance, which is where most people think that some sort of recessionary experience is likely to emerge, consumer discretionary stocks, when you exclude Amazon and Tesla, are trading nearly 2 standard deviations below their pre-pandemic 5-year averages. So we're relatively prepared for an environment of slow growth. What the equity market continues to struggle with, and we've talked about this ad nauseum for the last 2 years, is not about growth. Companies are very well prepared for a slowdown in growth. They've talked about a slowdown in growth coming for a long period of time. Where they struggle, and where they probably will continue to struggle, is with inflation and inflation volatility. So if we're moving into an environment where growth slows, they can contend with that. They've largely prepared for that. They've talked about it for a long time. What they're not prepared for, and what they continue to struggle with, is an environment where growth does not slow and inflation remains high and sticky. That's the difficult point in time for equities. We certainly had that throughout much of 2022. We contended with fears of that environment reemerging over the last 3 months. So anything that confirms that that environment is going away is going to be perceived positively by stocks.
Gina, thank you so much. I'm still not brave enough to buy my first share. Gina Martin-Adams holding my hand here in the equity market, surging futures up at 21. She drives the show at equities at Bloomberg Intelligence. I'm going to say this, Lisa, it's a sea change from the BKX Bank Index with a nice bounce that we saw yesterday, just to get up to the top of a 2 standard deviation range is up 16%. That would be the pop in the bank index, is the grimmest of grim.
Which is interesting, given the fact that it used to be that higher rates would help the banking sector, and all of a sudden lower rates helps the banking sector. There is a feeling on the street right now that suddenly stable rates or the idea that the Fed is done will bring so many more deal makers, issuers, et cetera, back to a market after really being on the sidelines for a while.
Just now getting a glimmer of a pause here in the various surges and movements that we see in the markets. I'll focus on equities up 20, where they were up a little more earlier. The 2-year yield, Lisa, I know you're focused there, 4.88%. But you just wonder, when people who have bet away, not short, but they've bet away, or they're just on the sidelines, whatever that means, cash or whatever, how do they interpret the week that you and I have lived? John didn't live it, but we did.
When I think about Michael Hartnett, who has been relatively bearish and over the longer term sounds like he still is, he said that the momentum that we have seen and the trading that we have seen over the past couple of sessions does give him the sense that we could see that year-end kind of Santa Claus rally, as they call it, just simply because there is a lot of momentum behind this.
Just looked at one statistic here, the 10-year real yield coming down even more now, not a pause there. 2.18% from a 2.50%. That is a seismic move in the inflation-adjusted yield over this week. Thanks to our team for just a spectacular week. The acting Labor Secretary, Julie Su, at 10 a.m. Raphael Bostic this afternoon on Bloomberg.